Okay, there we go. Start recording that way. What I'm going to do is I'm going to save this and I'll upload it to my YouTube channel. That way, if you want to go back and review anything, you have to go back and review it. Okay. Okay. You got that, Sam? I'm going to save this and put it on my YouTube channel.
Ma'am.
All right. So welcome to the AccuTax Service training course. I am thrilled to have you here and appreciate you taking the time out of your day to come join us today. The course is designed to provide you with a strong foundation in tax preparation. By the end of this training, you'll have the skills and the knowledge to confidently prepare and understand basic tax returns. So basically like simple tax returns, W-2s, that sort of thing. Anything higher than that will be one of the senior preparers. Our sessions will be fast-paced, but they will be comprehensive, covering various essential topics. We will aim to keep things moving, so it's important that you feel comfortable asking questions along the way. Addressing uncertainties early is very, very important, okay? So if you're not clear about something, just make sure you speak up so that we can clarify it for you. Accuracy in tax law interpretation is vital for both our success and the trust of our clients. So let's go ahead and get started. Now, in your forms, in your side pocket, you have sample forms. They kind of look like this. Like this. It's going to be the 1040. Yeah, it's going to be a whole packet. It's going to be the 1040. You're going to have, and the 3 schedules. All right. Go ahead and pop those out because we're going to be referring back and forth to those. Let me take my own advice. Okay. So session 1 is going to be an introduction to the forms. All right. So in order to learn how to prepare taxes, we do it based on the actual forms versus asking questions or like the interview process. Okay. Our software is forms based. So when you go to learn on the computer, it's gonna basically look like the way the tax return looks. It's gonna go in the same sections as the actual 1040. Okay. So since it closely resembles the 1040, that's why it's important for us to learn this return line by line. That way we can know what goes where, but more importantly, why it goes there. So that if you're asked, because you will be asked, well, why are you doing it that way? We can tell them, this is why we do this, because doing it in this certain order makes it flow where it needs to go. Okay. So look at that provided 1040. We're going to use it as a guide for each section. Now, the 1040 is divided into different sections. Each section will discuss them depths as we go on, but I want you to become familiar with them. The sections are the heading, that top section, the heading, that's where the names, the addresses, social security numbers of the individuals filing the tax return goes. Right? They're also going to put in their address. The filing status shows if you're a single, married, head of household, married filing separate, or qualifying widower, which is now called qualifying surviving spouse. So they did change the name of that from qualifying widower to qualifying surviving spouse. So I might interchange those because it's new. It's new for my brain. Right. Okay. Digital assets. This has become very important the last few years. A taxpayer must claim digital assets if they bought or sold or received anything like Bitcoin. Bitcoin is a real popular one. We call it digital money. It's easier to explain if we tell them digital money. Like, you know how the kids play that game Fortnite? And they can buy those different things. That's digital money. Technically, the money that you earn in Fortnite is taxable. What? Yes. Technically it's taxable. Right. So that's just a little tidbit you can explain to your clients. Well, think of it this way. So, but it's Bitcoin, NTFs, those paintings that have like code in them that people sell. That's considered a digital asset. The standard deduction is in this portion of the 1040. The standard deduction refers to whether or not someone can claim you as a dependent. Okay. A lot of the times mom and dad can claim Junior or Princess as a dependent because they're still in school. So like I can still claim my daughter because she's 21 and she's still in school. Even though she's over 18, I can still claim her because she's still in school. So when she files her tax return, she has to say that she is a dependent of someone else. And that affects her standard deduction. Okay. So you know how everybody gets a standard deduction?
Right.
Somebody who's a dependent doesn't get that standard deduction.
But she still gets a certain amount of her income.
She will get her, depending on how much she made, she'll get her withholdings back. Okay. So she still has to file a tax return, but she has to say that she's somebody else's dependent. All right. Dependents. These are the number of individuals on your tax return that you are eligible to claim. So your children, grandchildren, your parents, if you have maintaining a home for your parents, then you can claim your parents. Income and adjusted gross income are now put together on the 1040. So income is income that you've earned from working or unearned income like from bank accounts. There's hundreds of different types of income, but just to simplify, there's earned income and then there's unearned income. Earned income is money that you actually work for. Unearned income is like money from bank accounts or unemployment. That would be considered unearned income.
What about disability? That would
depending on the type of disability is not taxable. So you don't even have to claim it. Oh. Tax and credits, next section. Tax and credits. That would be on page 2 of that 1040. In this section, this is where you enter the standard deduction that we were talking about earlier. Let's cross this out. Where not your exemption amounts, because there's no longer exemption amounts. But you would enter based on your standard deduction, whether you're single, head of household, married, filing joint, you would put that amount that's given to you in that section. Payments. Payments are what was withheld from your W-2s or your 1099s. Anything that you've received as far as earned income credit and additional child tax credit. Okay. Next section is refund. This is the amount of refund that is due to you. And then almost last section, amount that you owe, obviously, what you would owe to the IRS if you have to pay any of that back to them. And then next will be the third party designee. This was something that I used to avoid, like don't put anything there. It designates the tax preparer as a person that they can discuss the return with the IRS. Okay. I found it very helpful these last few months. If we had a designee there, that person can speak on behalf of the taxpayer to the IRS to find out things like what's going on with the refund, if we can get copies of transcripts, things like that. So I may implement doing office manager names. Here we do my name, but maybe doing office manager names in the designee portion. That way that person can at least call and say, hey, because I've had a few refunds released just doing that, just calling on behalf of the taxpayer and asking what's going on, and have had a few released that way. The sign here section, it's an obvious section. The client and the spouse, if there's a spouse, sign the tax return and date it before they mail it. So this is a mailing situation. And then pay preparer's use only. This is where the information, the company information and the tax preparer's information goes. So now, way back in the day, you used to put your social security number. It would be your name, your social security number, company name. They don't do that anymore, thank goodness. So now what we do is I get y'all prepare identification number. Okay, and so that attaches to your name. So your name, your P10, call it a P10, and then our company information. Okay, so that way taxpayers aren't stealing information because they work. So any questions on the sections of the tax return? All right. So we're going to move on to the label portion of the tax return. So just take a second, look over the top part. It's going to have the names, first name, last name, social security number. It's going to be this one. Yeah. Address. It asks if they want to donate to the presidential election campaign fund, filing status. All of those things are in the heading. So completing the heading. The tax return has designated spaces for the names of the primary taxpayer, the secondary taxpayer. The primary taxpayer refers to the person listed first, while the secondary taxpayer refers to the person listed second. Both taxpayers equally own that tax return. Okay. We just need an identification point. So I know a lot of the times the husband will assume that because he's working, it's his tax return. But that's not true. Okay. That tax return equally belongs to both of them. Regardless of whose income's on there, regardless of who made it, who made more, it equally belongs to each of them. Once a couple files their return in a certain order, they should always file it in that order. Because what it does, the IRS gets confused very easily. And any change can trigger a delay. Any change. If you put in a middle initial 1 year and you don't put it in the next year, it can trigger. If you change the address, it can trigger. Filing status changes, triggers. So you have to be careful. And our computers, if it's a previous client, our computers bring that information forward from last year to this year. But we always have to verify and make sure that information still remains the same.
So shouldn't it go with your driver's license?
No, it has to go by your social security card.
Really?
Yes, it has to go by what's exactly on your social security card.
So what if your social and your driver's license don't match?
You hyphenate. So say like my name is Denise Becerra. I'm hyphenated. So my maiden name is Becerra. My married name is Flores. So it would be Denise Becerra-Flores with just a hyphen. Now, that's only if you need to cash your check. You need to use your ID to cash your check. IRS doesn't care. IRS is only going to go by the first 5 letters of your last name. That's it. So no, you can put XYZ at the end of that, and it's not going to matter to the IRS. First name doesn't either. Strictly last name and social. But because I mean, we all make mistakes, and last year I made a mistake, and I put in a completely different name, first name for somebody. Well, he was Mexican, wasn't he? Yeah, but he was a lawyer too. Yeah, I named him like Donald or something, and his name was like John. I mean, it was like completely, and I didn't catch it. Now, it would have been fine if he wouldn't have received a paper check. But he received a paper check.
And he didn't catch it.
He didn't catch it while he was signing. No. So we all make mistakes, but it's very, very important to make sure that you're verifying that social. Yes. So you must provide the first name, middle initial, and last name of each taxpayer. So just going to reiterate what we were talking about. It's important to note that just because a couple is married doesn't mean that they have the same last name. Always use the names as they appear on the Social Security cards. If one spouse has adopted a married name but has not changed it with Social Security, you must still use the name on the Social Security card. So if her maiden name is still on that Social Security card, you use the maiden name. Alternatively, you can hyphenate the last name, such as Smith Jones, with Smith being the on the card and Jones being the married name.
Especially if they get married during
During the year, right? Okay. There's candy in the back too. There's snackies.
It's so good. I got salad.
Okay. So, and also ensure that you enter the Social Security card, Social Security numbers correctly as well. This is probably one of the most important aspects of that tax return. A Social Security number entered incorrectly can result in a tax return that has been rejected by the IRS. So that means that the IRS will send that tax return back to us, and it needs to be corrected and then resubmitted. Okay, so I know it doesn't sound that bad because we get to refix it, but having mistakes like that costs us time and manpower. So doing it right the first time ensures less wasted time the next day. Okay, you're going to enter the taxpayer's home address. This would be the address that they reside at, where they're living, and where they receive mail. It's also important that the address is entered correctly. A wrong address can cause a taxpayer not to receive important notices from the IRS. This has happened on more than one occasion, where a different, like it could be the right street address, but it's the wrong town. Okay, the zip code, you put in the wrong zip code, because in our system, if you just put in the zip code, it'll bring up the town. You know, we'll put in El Campo when it should have been Wharton, or we'll put in Wharton when it should have been El Campo. So you have to be very, very cautious of those addresses and make sure that they're getting put in correctly, because by chance that customer gets a notice from the IRS, he's never going to get it, or she's never going to get it because it's going to the wrong address. And then they don't know that they're having issues. Okay. The next section that we're going to go into depth about is going to be filing statuses. Any questions about the heading? No? Okay. Filing statuses. There are 5 filing statuses. Single, head of household, married filing joint, married filing separate, and qualifying surviving spouse or qualifying widower. By looking at them, you would think that it's easy to determine which one to use. They sound like they would be easy, right? Like they would be just obvious. It's not the case at all. Single, you would think should be an easy decision. If you're not married on the last day of the tax year, December 31st, you're considered single. Okay. However, it's not always as straightforward as that. So for instance, you have a person who has children, provides a home for them, but is not married at the end of the tax year. So therefore they would not be single. They would be head of household. So a single person,
No children.
is just if you're unmarried at the end of the tax year and you do not provide a home for another person. Okay, then you're classified as single. So if you're living at home with your parents, you don't have any dependents, and you're just filing just to get your withholding back, you're single. If you are by yourself, you live in your own apartment, nobody else lives with you, you don't provide a home for anybody, you're single. If you are a college kid and you have a roommate, technically you're splitting things, you're not providing a home for anybody, you're single. Okay. Married filing joint. If you are married on the last day of the year, if you are married December 31st at 11:59, you're married. Doesn't matter that it's the last day of the year. Doesn't matter that you were single and didn't live with anybody. The other 11.9 months of the year, you're married. For tax purposes, you should file married filing joint. Okay. It doesn't matter if only one person is employed. You still file a joint return. When entering the return, you list the person who filed first last year as the primary taxpayer. So if they're brand new and they're never filing together, you can ask them who wants to go first on the tax return. We live in a very patriarchal world, and I am prone to it too, where we list the man first. We list the man first. It's habit. But honestly, we should be asking if it's a new taxpayer, if it's a new situation, if they've just got married, who wants to go first on the tax return? A lot of the time, I've done it, and I'm probably the most feminist person in this room.
But you've been a lot of cases where you put the woman first.
Yeah.
So that's really not based on their income then?
No, never. It's based on who
whoever
prefers.
wants.
Yeah. Who prefers to go first? Yeah. She could have zero income, and you could put her first. It wouldn't matter.
So like if they're our client
And
and then they get married, and then right then you would ask.
you would ask, right? If they've never filed a return together, right? You would ask who would y'all prefer to go first on the return? Okay. In Texas, of course, is a common law state. So if you claim that you are married, but are not legally married, you would still file married filing joint. So if you're running around town saying, this is my wife, this is my husband, in Texas, you're married.
Yeah.
So technically, you would file married filing joint. Yeah. Yeah, don't run around out there saying, this is my husband, this is my. The next one is married filing separate. Married filing separate is the least beneficial filing status to choose from. In Texas, there are very few advantages to filing this way. Sometimes it's unavoidable. Sometimes a situation arises where a couple is separated. They do not get along. They are not amicable at all. And they do not want to file together. They can't see eye to eye on anything. So you would file those tax returns married filing separate.
But they still come in together, or they come in?
They can come in separately. They can go to two different places.
Okay.
But if one files married filing separate and the other one doesn't, we'll get a reject. And then we'll have to put in, unless say mom has kids. There's so many varying situations. This is very simplified. Mom has the kids, dad does not. He files married filing separate. She files head of household. And then in that case, she doesn't need his information, but he still needs her information. He needs her, because if he's filing married filing separate, he needs her name and her social. So the IRS knows
that they're two separate.
All right. Head of household. This is the filing status. You can tell that it's a little more in depth, but because we see this consistently, and we have to be very diligent about filing these tax returns. So head of household, if you're unmarried and you provide a home for your child, your stepchild, your grandchild, your foster child, your parents, siblings, nieces, or nephews, paying more than 50% of the cost of keeping up that home, you may qualify as head of household. To use this status, your unmarried child does not need to be claimed as a dependent, but they must live with you. So to explain that. So mom and dad get a divorce. The divorce decree states dad gets to claim the child on the odd years. Okay, as a dependent. Well, it's an odd year, mom's filing. She can still file head of household because the child lives with her, but she's not claiming that child as a dependent. What she's doing just for the filing status. And in our computer, there's a place, there's a little line where you can put that child's name in to show that child lived with her or him, lived with her. But she's not going to claim him as a dependent. Okay. Now, as for your parents, your parents, you can claim your mom or your dad as a dependent, even your grandparents, you can claim them as a dependent, and they can live in a separate home or in the nursing home or assisted living, but you still have to maintain up to 50% of the cost of their expenses, of their, either you're paying the bills in their home or you're paying for their care. But it has to be, you have to maintain 50% of their support. And your parent is the only person who does not have to live with you. And you can claim as a dependent. Clear? No?
Yeah.
Yeah.
I'm just thinking of my situation on that one.
Yeah. It does. Going through this stuff does make you think, oh, well, I could do this. Or yeah. All other relatives have to live with you in order to qualify as a dependent. So it's just strictly your parents. A married person, like we were discussing earlier, a married person can only use the status under specific conditions if they are separated from their spouse and not lived with them for any part of the last 6 months of the year, not even one single night. So if he moved out in February and you try to reconcile in July, he can't spend the night. He can't. He can come, he can play visit, but he's got to leave, or else in a booty call. That's it. Otherwise, technically, and it's not like you have the IRS in bed with you, but technically, you would have to go back and file married filing joint versus head of household.
That's crazy.
Yeah. So, okay. Not even for one night. They must provide a home for the dependent child, and they cannot file a joint return with their spouse. They can file head of household. So it's just a little note that in our communities, of course, we are in a lower income area. So most of our tax returns are single parents, just head of household, a lot of earned income credit. Okay, so that's the majority of what we've seen. Our demographic is kind of changing here. I think it's the building personally, where we're getting more complex returns here, but the majority of what we do is still single parents, head of household, earned income credit. Okay. The last one is qualifying surviving spouse. So in the year of death, the surviving spouse can file a joint tax return. So mom and dad are married, dad passes away. That first year, mom would still file a joint tax return with dad. Okay. For the following 2 years, if the surviving spouse, if mom remains unmarried and still has a child living at home, she would file qualifying surviving spouse. So the benefit to that is that she gets the same monetary standard deduction as married filing joint. So her standard deduction doesn't go down. So she still gets that higher standard deduction for 2 years. Okay. And then after that, if she doesn't remarry, she can file head of household. Right? Of course, she has to maintain the cost of that home. She has to provide her 50% of support for that child or for those children. Right? So the next section after those filing statuses, if you look over underneath the Social Security numbers on that 1040, where it says Presidential Election Campaign Fund, this is where they ask if the taxpayer would like to donate $3 to the Presidential Election Campaign Fund. I always mark no. I don't even ask them. I always mark no. because more often than not, it's going to be used for evil. So it doesn't reduce the refund amount. What the government has is they have an account set up, and they just, if a taxpayer elects to donate $3, they just take $3 from that account and put it towards the candidates, both equally. Yes. Now I wish that you could choose who you would like it to go to. That would be something, government, but you know, who knows, we're going to have a government by next month. And then it's also going to ask in the heading portion, if at any time in 2024, did you receive, sell, exchange, or otherwise dispose of any financial interest in virtual currency, which are digital assets like Bitcoin, Dogecoin, or NTFs? So that digital money that we were talking about earlier. So we do have to ask them, because the IRS is very nosy about that right now. They want to know. They want to know, like, even like, you know, how on Cash App you can buy Bitcoin. You can buy stocks on Cash App. So if you're doing any of that, you need to, if you're buying and selling, you need to say yes to that question, or your taxpayer needs to say yes to that question.
And if they don't, and they are doing it, it's going to catch it.
If those companies are reporting it to the IRS, then the IRS will catch it and they'll get an under-reporting.
But then that won't be on us.
As long as we've asked the question, then it's not on us. But if the IRS feels like we didn't ask the question, then yes, we could be penalized.
That's on one of those forms, isn't it?
It is, and then it's on the main info sheet too, when you're asking about, because after you ask about
they have to sign
market care, the marketplace, it's right underneath that. All right, so any questions on that? We good? Samantha, we good?
Yes, ma'am, we're good.
Okay. All right, so we're going to move on to session 2. Session 2, underneath the digital assets, again, it says standard deduction. Standard deduction, we're hearing this over and over and over again. Standard deduction, according to this portion, this section, is whether or not you or your spouse can be claimed as a dependent by somebody else. Okay? Or whether or not your spouse has itemized on a separate return. So in that, say in that married filing separate situation, if both spouses are married filing separate, and one itemizes their deductions where they take things like their mortgage interest and their property taxes, if they itemize, the other spouse has to itemize. They cannot use their standard deduction, even if they don't have anything. So even if they have nothing except for personal taxes, like, you know, what we pay on our goods, then they have to take that versus the standard deduction that's given to us. Okay. Age and blindness, you're going to check this if the taxpayer was born before January 2nd of 1960. Or if they're blind. So the reason that that's important is because our older taxpayers get a higher standard deduction than our younger taxpayers. So if they're over that age, if they were born then or older, I didn't phrase that correctly, then they get, I want to say it's like $1,900 more added onto their standard deduction. Okay, so when we're inputting this into the computer, we're putting in their age. We're asking them how old they are. We're looking at the driver's license and inputting their age, and it automatically takes care of that for us. Okay. Dependents. Okay, so you can see on the 1040 that dependents kind of has a similar classifications as taxpayer and secondary taxpayer, right? It's going to ask you for their names. first name, last name. It's going to ask you for their social. It's going to ask you for their birthday, right? But in addition to that, it's going to ask you for their relationship to you. How is this dependent related to you? Is it your child? Is it your grandchild? Is it your niece? Is it your nephew? It's also going to ask you if that taxpayer or if that dependent qualifies for child tax credit, if they qualify for earned income credit. Because checking these boxes, you're going to put in their name, you're going to put in their birthday, you're going to put in their social security number. You're going to check those two boxes in the system. You're just going to automatically check them. Because after you input that information, after you input their income, the computer's going to figure those credits out for you. All right. So it's just important to just check those boxes. Right. And then our computer will even ask how long those dependents have lived in your home. So did your dependent live with you? Oh, did Charlie live with you all year? Yeah, Charlie lived with me all year. And put in 12 months. Oh, well, Charlie only lived with me for half the year. Well, is that 6 months? Yes, that's 6 months. You're going to put in 6 months. Because the credits are going to calculate based on whether or not that child lived with you or lived with that taxpayer for the year. Okay. Now, we're sitting here talking about dependents, but what is a dependent? Okay. For tax purposes, a dependent is someone who relies on the taxpayer for financial support and meets specific IRS criteria. Claiming a dependent can provide valuable tax benefits, such as eligibility for tax credits like the child tax credit and deductions. So a dependent is somebody who relies financially on the taxpayer. That's your dependent is your child. Like I said, it's going to be your child that you're providing a home for, your grandchild that you're providing a home for. You support them. They depend on you, dependent. They depend on you for their financial support, for their well-being. Okay. If a dependent child is being claimed on his parent's return, he cannot claim himself. We talked about this earlier. So a dependent can only be claimed one time. And it is possible to file a tax return if somebody claims you as a dependent. So we talked about this. Your son's in school, he's going to college, he works, he can file his tax return. He just files it as dependent of another. Somebody else can claim him. All right. Mom and dad still claim him as a dependent. All right. So in order to be claimed as a dependent, 5 tests must be met. As a little memory jogger, Red Cross Jeeps go slow. Do we use that? No. Red Cross Jeeps go slow. Relationship, red. So to meet the relationship test, taxpayer has to be a member of the household. They have to be a qualifying blood relative or member of your household for the entire year. The citizenship test. They must be a U.S. citizen, resident, or resident of Mexico and Canada for some part of the year. So technically, husband's here, family's is in Mexico. Technically, he can claim them. He can apply for an I-10 for them, an individual taxpayer identification number, and he can claim them as spouse as a spouse, his children as dependents. Now, the children will not help him at all. Spouse will, but the children will not. But he can claim them, even though they're living over there. Okay. The next one is joint return. They can only file a joint return if they're just to get a refund. They have no tax liability. So your daughter's in school, she runs off. Okay. Family situation. My brother was in school, 19 years old. He snuck off and he got married. Okay. Mom and dad were still supporting him, still paying for college, sending him money, but he snuck off and he got married. This is real life, y'all. And so technically, mom and dad still claim him as a dependent, because even though he got married and he can file that married filing joint tax return, he only worked a little piddly like Pizza Hut or something. So when he files his tax return, he's only filing to get back his withholdings. There's no other deductions, no other credits, no nothing, just his withholdings, just the same as a regular college kid. So technically, mom and dad can still claim him as a dependent. Her parents could also still claim her as a dependent. They could still file a married filing joint tax return. They would just say they are dependents of another.
But what if they choose not to?
Not to file together?
No, not to say that they got someone underneath them, someone claiming them. Like just say if there's a situation.
Well, then a lot of it depends on who files first. So if mom and dad have already filed and claimed him as a dependent, then his tax return is going to get rejected. It's going to get sent back. And the same in reverse. If they file, if the married couple files first and then mom and dad file second, then mom and dad's tax return is going to get rejected.
Okay.
Yeah. Who's it? Oh, based on all of our cards. All right. So that is any questions on that portion? No? Okay. Cool. Okay, so the next section is growth, or the next test is gross income. A dependent may not make over what would be considered the exemption amount for 2024, which is $5,150. Okay, so your dependent technically, because there's always an exception, technically cannot make more than $5,150 in order for you to claim them as a dependent. But there's always a but. If your dependent is under 19 or a full-time student that is under the age of 24, then that income test can be waived. So my daughter's in college. She's working her butt off over there. She'll probably make about $25,000 this year. I can technically still claim her as dependent. As long as as long as she saved her money, which she didn't, then I can technically, because I would still be providing her support. I'm still paying her rent. I'm still buying her groceries, whatever. So technically I could still claim her as a dependent. All right. And then support, the final test. It can be the hardest one to prove. You must provide over 50% of your dependent support in order to claim him or her. So you have to be paying the cost of the rent or the mortgage, your property taxes, your bills, like all of your utilities, their clothing, their grooming, health insurance, all of those things account for their support. And you have to provide over 50% of that support. Okay. A lot of the time, they're getting child support. Child support doesn't really count towards their support. Was the water cold? Nancy, what was that? All right. So, because we'd hear it. Yeah. Okay, so now we're going to go over the bottom of that says go to the class problems. You're going to do exercises 1, 2, and 3 for session 1 and 2. So in your class problems, you're going to do exercise 1. You're going to complete the headings. All right. There's 4 of those. And exercise 2, you're going to read each one. You're going to determine the filing statuses for those taxpayers. And then exercise 3, you're going to determine how many dependents these taxpayers should have had on that tax return, or should have on that tax return, okay? So I'll let y'all have fun and do that. I already did mine. anybody need anything from the back?
You have coffee back here, by chance? I have a coffee pot. She doesn't drink coffee, huh? These? No. No? This one. Oh, you don't drink coffee? I told her it sounds like elevator music. Out of curiosity, does anybody know just, what those new apartments are going for over on the? Yeah. Yeah, they are. They seem rather nice.
Yeah.
I'm sure they got a nice price.
You're pretty good. My money has been killing me. When you had to do it by hand?
Yes.
Yep.
Oh.
That's what I learned. I'm doing it by hand. I did like a 6-week H&R Block class.
Oh, did you?
Back in,
What year was that?
oh my God, like 95, maybe 96. When did I have baby David? I had baby David in 98. Yeah, maybe 96. Damn, that's a long time ago. Damn. Damn, I've only been doing this for almost 30 years. Like 20 years. Yeah. Just telling you the answers.
Huh? I didn't tell her the answers.
No, now there's a MFA, a multi-factor authorization on the computers to log into TaxWise.
Oh, really?
Yeah. So what I did here, I still have to do it in Wharton and Bay City, but I'm
We're
putting,
gonna have to send us codes.
it's gonna send you a code, but I'm gonna do it to each device. So like here, I did on the iPad. Wharton, I'm gonna do it on the thing for the square. Your office too, I'm gonna do it for the square.
Okay.
But it's gonna go out every 180 days. So you'll have to like re-authenticate after 180 days. Yeah, I was like, I mean, thanks, but no thanks.
I was just talking about that multi-factor thing with my brother, because he's had issues.
Yeah, everything uses it now, but
Right.
they have to. Okay.
Yeah, I just feel like I messed up on two.
Yeah, we're gonna go over. Okay. Now, did you do the other two exercises?
1, 2, and 3.
Flip the next page. Flip that page. You're gonna do that one, and then you're gonna do the next
So you do
page.
the bottom one also?
Yes, you're gonna do the bottom one.
Okay, 1 minute. Okay, gotcha.
I shouldn't have it. I have it there. Yeah, I have this. Yeah. There we go. Okay, we're gonna go just a few more minutes and then we'll go over everything, okay? A little bit less than a minute and then we'll go over. Mm-hmm. I couldn't figure out how to lighten it.
That's good though, because they always say like.
Yeah. 1, 2, and 3. All right. When it comes to a stopping point. Let me go back. All right. So let's go over class problems, session 1 and 2, exercise 1, completing the heading. And I'm going to flip these over so that I can show you as we go. So the first one, Jade and Olivia Michelson. Jade lives at 1758 Fulton Street in Wharton. Jade's social is 478413298. Ooh, typo. Jade says yes to the presidential election campaign fund, and she did earn $500 in Dogecoin. So how are we going to complete the first problem?
Her first name,
Mm-hmm.
O as middle initial, Michelson as last name, social,
Mm-hmm.
address, 58 Fulton Street, city, Wharton, state, Texas, zip code 772.
Campaign fund. Okay, did everybody get that? So we got her first, her last name. I'm showing her. Yeah,
Okay,
first and
so-
last name, social, and then her complete address. And then she said yes to the presidential election campaign fund. All right. So the next one, Hunter Zoda and his wife Stacy. They live at 724 Northeast Gate Avenue in El Campo. Hunter Social 459138954. Stacy Social 645746451. They both said no to the presidential election campaign fund, and they don't have any digital assets. So how are we going to complete that heading?
Stacy first.
Mm-hmm. Or so you can ask them
Okay.
if they. I put Hunter
I
first, but you can ask them how they would like to file that return. Who would like to go first if they're brand new?
Mhm.
And you can put either or.
I went by the social being first.
Okay, just
social-
whoever was first in the problem.
on the problem. Mhm.
Yeah, that's fine too. I mean, I just did Hunter because I'm used to it. So I did Hunter Zoda, Hunter first name, Zoda last name, his social. I did Stacy first name, Zoda last name, her social. Complete home address, North Eastgate Avenue.
Can you put
You can
AVE?
Yes, you can
Okay.
abbreviate. And then city or town is El Campo, state is Texas, zip code 77437. Everybody good on that one?
I don't mean to go on her last name because it's the same as his.
Right. So in the computer,
Yeah.
if their last names match, you
Yes.
don't have to input hers. Just a time saving technique.
Okay.
I always put in both regardless. Number 3, Ted Yansky and his husband Jim Solis live at 1102 Alamo Road in Louise. Ted's social is 461527896. Jim's social is 945657841. They both said yes to the presidential election campaign fund. Ted and Jim were legally married in New York. So, and Jim's company gifted him $10,000 in Bitcoin as income. So, first question, can they file a joint tax return?
Yes. Mhm.
Yes. Yes, they can. Even if you live here in Texas, they can still, because federally, the Constitution still sees our marriage as valid, as legal. So in Texas, because the tax return is federal, they can file a federal tax return as married filing joint. Okay. So it'd be their first name, their last name. Whoever wants to go first, doesn't matter. They're both guys, so there's no patriarchy involved. So either one. Ted Yansky, his social. Jim Solis, his social. But did you see his social? It's an I-10. So to identify, an I-10 is going to start with a 9. Okay, so that's not a social.
But you still put it down.
You're going to still put it in there,
down.
right? Now later on, there's some consequences tied to that, but they can still file a joint tax return together. Address is 1102 Alamo Road in Louise, Texas at 77455. Everybody good on that one? Amanda Cruz and her son Hector live at 6357 Torah Avenue in Edna, Texas. Amanda has an I-10 and Hector has a social. They have no digital assets. So how would this heading be completed?
First, last name Cruz, her I-10 number, and then her address, city, state, zip code.
Right. Hector was just thrown in there as additional information. That was just a, hey guys, y'all paying attention?
That's why.
I like doing that. All right, so the next exercise. Indicate exercise 2. We're going to indicate the filing statuses in each of the following cases. So we're going to try to determine, based on the information that we have, what their filing status would be. Whether that would be single, married filing joint, married filing separate, head of household, qualifying widower, or qualifying, surviving spouse, whichever one. Okay, so a couple, they were married on December 31st of 2024. How would they file? Married filing joint. All right. A couple married on January 2nd, 2025. how would they file?
Single,
How could they file?
married joint.
They could file married filing.
They could
Well,
file-
I put both.
Right, I put both. They could file either separately, they could file single, or if they were living together previously, they could also file married filing joint. So you could ask them
Which way they would.
which they would prefer. Huh? Or, I mean, even if they have children, if they weren't living together, one could file head of household, one could file single. So, I mean, there's a lot of different scenarios so that we have to be proactive and kind of think these situations through. The next one, a divorced male taxpayer with no dependents.
Or head
Well,
of
it
household.
can be in the household.
Right. So we're going to ask him, when were you divorced? Right. Because if he was divorced at the end of last year, technically you could still file married filing joint. You could file married filing separate. He could file head of household if he has the kids, or he could file single. So you have to make sure that you're asking the questions. You have to make sure you're asking, when was that divorce final? Did you live with your spouse at all last year? Who has custody of the children? I have custody of the children. Why doesn't she have custody of the children? So these are things that we're gonna have to ask, and these are things that you have to document that you've asked. All right, so you have to write that down. I asked taxpayer, when was he divorced? Taxpayer stated they were divorced July 4th of 2024. All right. Single taxpayer with a dependent child. Taxpayer maintained their home and the child lived in that home all year. What is that filing status?
Head of household.
That one's pretty much clean cut and clear. Head of household. Single taxpayer living with his girlfriend. Single.
Mhm.
Yeah, that was a tricky one, huh?
Yeah.
Right, they'd be single because he wouldn't be able to claim that his girlfriend is a dependent.
Yeah, okay.
Single taxpayer living with her parents all of 2024, but she has a dependent.
Head of household.
Single.
Single.
She lived with her parents.
Okay, so they don't.
More often than not, the parents are supporting her and her child. So the parents would claim her and her child as dependent. It's gonna go to whoever has the most income.
Okay.
Single taxpayer living with a roommate. Single. A single taxpayer who supports her dependent mother, and the mother lives in her own home. Head of household. But did we ask who's maintaining that home for the mother? Are you paying more than half the bills in your mother's home?
It could be coming out of her
Right.
Social
So
Security.
if that's yes, then it would be head of household. If it's no, then she would be filing single.
Either or.
Either or. So this is another one of those things where we have to make sure we ask the questions. We can't just take them at face value anymore. A divorced taxpayer and her son who lived with her all year, but the son is a dependent of the father. Yes. So she could file head of household. We discussed this earlier. Even though dad is claiming that son is a dependent, because the son lived with her, she could still file head of household and not claim him as a dependent. Taxpayer's wife died in 2024. His 15-year-old son lives with him. What is his filing status? Married filing joint. Taxpayer's wife passed in 2023. 15-year-old son lives with him. Qualifying widower. So for the next 2 years, so for 24 and 25, he would file qualifying widower. And then the last one, a college student who lives on campus but is supported by his parents. Single. Oh yeah. Any questions on that? Any confusion? Any? No?
Still learning.
Okay. Yeah, it's a lot of nuances, lots of little details make a difference. Yeah. Exercise 3. State the number of dependents the taxpayer would claim on their, it should say 2024 tax return. Joe is 72 and married. His wife is 64 and blind. How many dependents do they claim? 0. Yeah,
Because
they're married filing joint. And your wife is never your dependent.
Oh,
Yeah, your wife is not your dependent, she's your wife.
Okay.
Yeah, so it's married filing joint. And that's one thing I'm like, she is not your dependent. Yeah, poor men, they get it from me. Oh man.
Very fun. Okay.
All right. Betty and Bob are married. They have a 4-year-old son. During the year, they had twins. During the year, they had twins. So we're talking about 2024.
Mm-hmm.
During 2024, they had twins. How many dependents do they claim? 3 for 2024. So it doesn't matter when those children were born, as long as they're born within 2024.
Okay.
So they again, December 31st, 1159, they could have been born and they would still be considered being with them for the entire year. Charlie supports a 16-year-old brother who is a full-time student. His brother's gross income is $5,675 from a part-time job. How many dependents can Charlie claim?
1.
Yes. Right.
He's over.
Right, because the brother is
Over.
the brother is under 19. He's still in school. And even though he makes more than the 5150, because he's under 19 and he's still in school, Charlie can still claim him as a dependent. Let's talk about Frank. Frank is single and supports his son and his son's wife, both of whom live with him for the entire year. The son is 20, the wife is 19. They file a joint return just to get the refund, reporting $2,500 in gross income. Both the son and daughter-in-law are full-time students. They do not live in a community property state. How many dependents can Frank claim?
We can still claim both.
2. He would claim both. And I put 3. I don't know why I put 3. I knew that answer was 2. Okay, so that one was, but because we went over and over and over that one was pretty easy. Gary's single. He pays $2,000 towards his 20-year-old daughter's college expenses. The remainder of her support is provided by a $2,500 tuition scholarship. The daughter is a full-time student. How many dependents can Gary claim?
We could full-time students. We could still.
He would still claim 1, because I'm sorry, but baby girl cannot live off of $2,500 for the year. All right. So Helen is 50 and supports her 73-year-old mother who is blind. How many dependents can Helen claim? 1. Because since she's supporting, we're assuming that support means 50% of her students she's maintaining for her. So then she would get to claim her mother. Kate is a 19-year-old full-time student at the University of Texas. She earned $3,995 from her part-time job in 2024. Sorry. Kate's parents claim her as a dependent. How many dependents can Kate claim?
No, because she's been claimed.
Right, 0. Janie and Gabriel are divorced. Janie works and supports her 3 children. They have lived in her home their entire year. Janie's divorce decree states that Gabriel has the right to claim the children as dependents until they are 19. I don't know who her lawyer was.
Right.
But how many dependents does Janie get to claim? 0. How many dependents does Gabriel get to claim?
3,
3.
because of the divorce.
Right. Damn, she got it. Now, just a little tidbit there. Technically, she doesn't have to go buy that divorce decree.
Because they've been living with her.
She can, according to the IRS, she can claim those kids. Yeah. And I have helped somebody fight that. And they got those dependents because the kids lived with him. Mm-hmm. Samantha is single and provides a home. Hey, you're single and provide a home for your 35-year-old son, who is of sound mind and body, but he is unable to find employment. Okay. How many dependents can Samantha claim?
1, because she's still supporting him, even though he's not working.
No. He's lazy. So technically she can't claim him because he's too old.
Oh, that is like, they have to be in school.
Right.
School or in college. Okay,
Right.
Gotcha.
So technically, yeah, she can't claim him. Now,
Full mind, there you go.
yeah, so same
Sounds-
situation. And he is disabled.
Now she can claim him.
Then, yes, because he's disabled,
She has to care for him.
right. But then you have to ask, okay, he's disabled, he's receiving disability. How much disability is he receiving? And if it's more than 50% of his support. So you have to dig further. But technically, yes, if he were disabled, 35, still living at home, she could claim him as a dependent. Julia, and here's the other situation. Julia, single, provides a home for her 35-year-old son, Peter, who is totally disabled. Peter receives Social Security payments of $572 a month. Can Julia claim him as a dependent? Yes, because I can guarantee you the cost of either rent or her mortgage and utilities is going to be way more than $572 a month. Especially now. Sylvia and Jackson are married and they have 3 children. They also are foster parents to 2 other children that were placed in their home by a government agency. These children have lived with them for 10 months. How many dependents can Sylvia and Jackson claim? 5. They would be able to claim all 5 as dependents. Now, they may not be able to get earned income credit for all of them because they weren't with them for the entire year, but they would be able to claim them as dependents. Hugh and Janice have been married for 35 years. In March of 2024, their daughter Elizabeth and her husband tragically died and left 6 of their children and left their 6 children in Hugh and Janice's care. Joseph is 20. He attends the University of St. Thomas. Sophia is 18 and a senior in high school. The twins, Jacob and Johnny, are 15, and Thomas Jr. is 8, and baby Rebecca is 1 year old. How many dependents can they claim? All 6.
All 6.
They would get all 6. Mm-hmm.
Why is that?
Because the
They're in
parents
school?
passed.
Oh,
The parents passed in March, which means that they lived with them for most of the year.
okay.
Now, we could get even more complicated, and they would get power of attorney for their son and their daughter-in-law. They would file a tax return in their name. Yeah, it could get really complicated, and let the parents still claim them that year, and then the next year they claim them as dependents. But
Okay.
for this scenario, we'll simplify it because yes, it can get fairly complicated and fun. All right, so do you guys need a break? You need a potty break? You need to grab a drink? Y'all good?
I did. I'm gonna get it for just.
Okay. I need another Dr. Pepper. I shall return. Good? Change it a little bit. ChatGPT, baby. He was on his game this morning. He dropped off drinks. This morning. I forgot to put my ring on. I forgot to put deodorant on. Yes, I mean, I don't think. Oh, those are cute.
Can't buy napkins anywhere. So I found one.
Who needs them?
I can make napkins.
You go buy material.
Oh.
And they
Click.
And you cut it, and then you use the fabric. The fabric, okay? Not, you don't sew it, use fabric.
It's in here.
It's no buy. It is no buy December. We're not giving these corporations more money. I'm like, literally the only Christmas presents I've bought so far are for Callie. That's it.
Well, I don't have a good Christmas.
You buy your kids Christmas presents.
Not really.
Bro.
Not really. They might get like one gift.
Well, the only presents I've bought are for Callie. And that's it.
They get shit all year long.
That's it. That's all I bought.
For Callie,
Mm-hmm.
a month ago, they sold or buy her shoe for her.
Callie, no, Hannah's daughter, the little girl. Yeah, that's it. How you bought me anything yet? I don't feel like it. I don't feel like it. I feel like they did us dirty with Black Friday and they didn't really lower any prices. If you notice and walk through Walmart, all the TVs and stuff are still there. Nothing, everything's still there. Nothing's been sold.
Nobody got money.
They weren't worried about that shit when they voted that.
Well, it's about to get a lot worse.
It's about to get bad. It's about to get real bad. If he makes it there. They need to release the CEO assassin and send him to Washington. No, who's your grandpa? Oh my God. No, ma'am. No. All right, let's go. All right, so session 3. Session 3, we're gonna go over the income, the fun part. Income. So if we're looking back at that 1040, line 1 is wages, salaries, and tips from your W-2. Yeah, we're gonna, okay, so in these sessions, we're gonna be flipping back and forth between the 1040 and the different schedules back here, because the schedules, like when we go over to say schedule 1, these schedules flow into the 1040. So we have to go back and forth. Okay. So for this session, for this part, we will only discuss wages. What are wages? Wages are monetary compensation that an employee earns from her employer for work performed. Wages are typically paid on an hourly, daily, weekly, or monthly basis, depending on the terms of employment. These wages are reported to the IRS via a W-2 given to the employee. They're also reported to the state. And I said the IRS again. So basically, a W-2 comes from the wages that you receive from your employer. Okay. Lines 1B through I are other types of employment, like household employee, scholarships, tip income. Okay, those are other different types of employment that you would technically put on the tax return. So according to the IRS, we're supposed to report all worldwide income. Everything that we make, we're supposed to report. So household employees, if we have like a gardener, a nanny, somebody working in our home, we are supposed to, if they make more than $1,500, we are supposed to withhold Social Security and Medicare and give them a W-2. And so that's where that household employee.
So where does the 1099 come from?
That is if somebody is self-employed or if they're doing contract labor. So that would be later on.
Okay.
That goes in later on. Line 1Z is an addition line. So you just add up all of that other income and you're going to put that on line 1Z. Line 2A is taxable interest. Taxable interest is the interest earned on certain investments or financial accounts that are subject to federal and in many cases state income taxes. This income is typically reported to the IRS and to the taxpayer on Form 1099 INT or Form 1099 OID or similar forms. If the interest is $400 or more, you are required to put that on a Schedule B. So it's an additional form. So if you have somebody with a bank account, and we saw it a lot this year, somebody with a bank account that had interest over $400, then you have to put that on a Schedule B. And then the Schedule B will flow it over to that line 2A. It's good practice just to put everything on Schedule B. If they get a 1099 INT, an interest statement from the bank, you just go ahead and put it on that Schedule B. Whatever it is, if it's $10, put it over there and it'll take it where it needs to go. Okay. Tax 2B, tax exempt interest like mutual bonds is reported here as well. Now, here in Wharton County, we have a lot of people who use Texas Gulf Credit Union. Texas Gulf reports their interest as dividends for some reason. They've always done it. Texas Gulf dividends are actually interest. They are not dividends. So if we see a Texas Gulf statement, we put it in as interest. Remember they messed up? Oh, Texas Gulf had a big goof this year, and they messed up their interest statements. Oh man,
That was fun.
yeah, they missed the decimal. These people were getting $1,000 interest statements, $2,000 interest statements when it should have been only $200. Yes, I was like, wow. And then we're sitting here like, dang, they had a lot of money in their savings account. Dang, they made a lot of money.
So when they corrected it, was it taken away from the person?
When we actually asked them to call the bank because we saw one that was like it was like what, 15,000 or something, wasn't it? Who had that? Was that you that had that big interest statement from Texas Gulf?
So you flagged it. You noticed it.
Yeah, we
Okay.
noticed it and we had them call the bank.
Okay.
And then the bank was like, oh yeah, we messed up. So then they corrected it. AccuTax, may I help you? I'm sorry, who is this? Hi, Shamita, I am teaching a class right now. Can I have you call me back, say about 5 o'clock? Well, 4:30? All right, thank you. Bye-bye. All right, so if you flip that page, you kind of gives you an example of what an interest statement would look like. I know it says 2016, but they pretty much all look the same. They haven't really changed the format of that. It shows the bank that they come from. the taxpayer's name. It'll show the amount of interest. Box 1 will show the amount of interest. And if you keep going, it has like box 2 has early withdrawals. Box 3 has the interest amount. Box 4 has withholdings. So if they have withholdings. So anytime you see a form like this and you're inputting it, you need to make sure that you put in everything that's on this form. Every box that has a number in, those numbers need to go in the computer on that form. Okay. Line 3A and 3B, they're qualified dividends and ordinary dividends. These are sums of money earned from owning stock in a company. So say you work at Walmart and you bought stock. Yeah, and they pay those dividends. They paid that earning in dividends, and they give you a 1099 DIV. So that's where that would go. If you received a statement from a credit union, again, showing dividends, it's normally interest. And then we also use the Schedule B to report the interest, the dividends. So top portion of the Schedule B is for interest. The bottom portion of the Schedule B is for dividends. 4A, line 4A, total IRA distributions. This is when you start receiving money from your individual retirement account or your IRA. It's there's a process to figure out what is taxable and carried, but most of the time this is reported to you on a 1099-R. 1099-R is retirement. R stands for retirement. You'll get that if you have an IRA or if you have a 401k. Line 5A, total pensions and annuities. This is when you start receiving retirement benefits from a company provided retirement plan. Most cases, they'll let you know what is taxable and to be included on 5B, but not always. And then again, this is also reported to you on the 1099-R. And if you flip that page, they'll give you an example of what a 1099-R looks like. You see, it's kind of the same format, the payer's name. It has the gross distribution. Underneath box 1 is 2A, and it shows the taxable amount. And it shows whether or not, if the taxable amount was determined or if it was a total distribution. You also see code, the distribution codes. Those are important to put into the system because it determines if that is taxable, how much tax, penalized, and how much penalty. Because if you're pulling money out of your retirement too early, you will get penalized for that. All right. Any questions about that? We see that all the time. 6A, Social Security benefits. Social Security, I cannot say that. Social Security benefits are entered on 6A, but will only be included on 6B as part of gross income if the taxpayer's income is too high. So if the taxpayer makes more than, was it 25? Social Security taxable. To make Social Security taxable is 25, right?
I think that's what mine said.
So if they make more than $25,000, then a portion of their Social Security becomes taxable. And we always have to explain this. We probably explain this once a day because people are under the assumption that once they start receiving Social Security, they can work as much as they want. And they cannot.
But if you go on the back of there, there's a thing on your back, like how to figure it.
Yeah, but we have computers.
But as far as them,
Yeah, they can see. Yeah, but 25, and it doesn't matter if they're married or if they're single. If they're married, the limit is $25,000. If they're single, the limit is $25,000. So it regardless, the limit is the $25,000. Line 7, capital gains or losses. This is where you report income you receive from the sale of things like stocks, land, homes, car. If you sell a car that you've had parked in your driveway, technically you would report that there. Yeah. Wow. So basically you're comparing what you've purchased it for originally for what you sold it for. And the difference is what's taxable. Right? You may, okay, so we're talking about land, we're gonna skip that. And so that's what your profit would be. And then that is what you would have to pay taxes on. So if you bought, or you might have to pay taxes at all on it. So say, okay, say you bought a car for $10,000 and then you fixed it up, you turned around, and you sold it for 20. Right? Then you're gonna pay taxes on that 10. But in reverse, you bought a $20,000 car and then you sold it for 10. You have a loss. There's a cap on the loss, but you get to claim that loss as deductible. The cap is $3,000. You only get to claim $3,000, and the rest of it kind of rolls over. But technically, you would still claim it. All right, line 8 is additional income from Schedule 1, line 10. So that's just a carry forward. It just carries forward from that. And then line 9 is an addition line. You're going to add lines 1Z, 2B, 3B, 4B, 5B, 6B, 7, and 8. And this is your total income. So now we're going to skip on over and we're going to look at that Schedule 1. Schedule 1, additional income and adjustments to income. So part 1 of this is additional income. It's more income. Different classifications of income. So Schedule 1, line 1, they're taxable refunds, credits, and offsets of state or local taxes. The only time you will use this line is if a taxpayer received benefits from or deducted state and local income taxes on a previous year's tax return. We don't have state taxes in Texas, so we don't see it. But if they worked in another state, say they worked in Oklahoma and they received a refund from Oklahoma and they deducted it on their tax return the previous year, then they have to include it as income. Okay. This is reported to the taxpayer on a 1099-G. So like I said, since we don't have state or local tax in Texas, we don't see it. I've probably, in my near 30 years, I've probably never put it on a tax return. So it's just something to know about, just to be aware, but more likely you'll never see it. Schedule 1, line 2 is alimony. Alimony received is also a form of income. If a taxpayer receives alimony, and we all know what alimony is, right? It needs to be included on this line. If it's paid through a state agency, they may receive a form showing the amount received, but only if this is a pre-2018 agreement and it has not been modified. So if your divorce decree states that you have to provide alimony to your spouse before 2018, like your divorce was final in 2016, you have to pay alimony, then she has to claim that as income. Anything after 2018, free and clear. Okay. Yeah. Now, yeah, special note, because we get asked this all the time. Child support is not income, and child support is not an expense. You're right. A lot of men believe that they can deduct child support as an expense. Yeah. And you cannot. And then they get a lecture.
You're supposed to provide for them either way.
You're right, exactly.
Hello.
So, Schedule 1, line 3, business income or loss. So remember how you were talking about a 1099? This is where that comes into play. So business income or loss is where you will need to include income reported to you on a 1099 miscellaneous or a 1099 non-employee compensation, NEC. Now, the difference between the two, a 1099 miscellaneous is going to be given directly to a service provider. So if I had, say, a roofer come in and work on my roof, and I paid him, then yes, then I would give him a 1099 miscellaneous. Okay. But if I paid one of you to do regular work here, I would give you a 1099 NEC, non-employee compensation. So a service provider, a company service provider is going to get a 1099 miscellaneous. An individual is going to get a 1099 NEC.
But if they make a certain amount or
Over $600.
Okay.
Over
Is the
$600.
only way they would receive one.
Right. So that's why we mainly see 1099 NECs, is because it's an individual. And a lot of the time they're given to people mistakenly when they should have received a miscellaneous and they're getting an NEC. But it all gets reported on the same line. This is when a taxpayer is working as a contract laborer and does not have any taxes taken out of their pay. Sometimes a taxpayer won't receive a 1099 miscellaneous or an NEC for the amount of money that they've earned, and that the employer paid for the same type of contract labor. But the law states it is still to be included with the other income. So even if a person or an individual was paid in cash for a service, they are supposed to claim that as income on the same place. Okay. The taxpayer is still considered a self-employed person for tax purposes. So any person receiving a 1099 miscellaneous or a 1099 NEC or cash is considered to be self-employed. It's basically the same as somebody who has a business or a business location. They will be required to pay taxes that are not withheld at the time when they file that tax return. So then the taxes that they owe, calculated based on what they've made, is going to be collected within that tax return, or they're going to have to pay the IRS. Okay. So in order to do this, you're required to complete a form Schedule C to report the income. So those 1099s don't go directly on this form. Then again, you're going to have to attach an additional form, a Schedule C, include that income on that Schedule C, any expenses that they have. So if it's a roofing company and they bought the shingles, they deduct the shingles. So they'll put in the income, they'll deduct the shingles, whatever labor they paid. All of that goes on that form. That bottom line, that number, then transfers over to the Schedule 1. And then from the Schedule 1, it transfers over to the 1040. So it does a skipping rocks. All right. That is a very basic explanation of that, because senior preparers will be doing Schedule C. Schedule 1, line 4, other gains and losses. We won't go into it. Schedule 1, line 5 is rental real estate, royalties, partnerships, S corporations, trusts. These are all reported on Schedule E. We do get a lot of these. Well, I do. Tish does. Nancy will. Rita does. We get a lot of rental property. I have started doing more estates, trusts, partnerships. All of that goes onto the Schedule C. Schedule E. From the Schedule E, it goes onto the Schedule 1. From the Schedule 1, it goes onto the 1040. But that's years down the road. Line 7, Schedule 1, line 7, you will see probably on a daily basis. Unemployment compensation.
Yeah, you skip six.
Did I? Oh, I sure did skip 6. Y'all are gonna see that one either. Farm income.
Farmers.
Yeah, we do a lot of farmers too. So farm income, same situation. It goes on it's basically the same format as the Schedule C. We're gonna put in their income, their expenses. Bottom line goes on Schedule 1. From Schedule 1, it goes to the 1040. And that is basically office managers and me will do Schedule Fs. We'll do farms. Farms are fun. That's the line 7 is unemployment compensation. We see a lot of unemployment. Last year, not as much as the previous year.
I wanna say
Yeah, so
Yeah. So, yeah, we didn't see a lot of unemployment, which is good. We didn't see a whole lot of unemployment last year. We probably won't see a whole lot this year. Unemployment.
we didn't have a whole lot last year.
No, that's because the Democrats were in office. Yeah, here we go again. It is a political situation. So in 2025, we should anticipate a lot of unemployment coming through. Yeah. Dang, that was a good talking point on the freaking. Damn, I could have. I like to argue with people. So we will see unemployment. And then if you flip the page, that little bitty picture shows kind of like what an unemployment statement would look like. Again, it shows the payer's name. Now these we do have to be careful because sometimes they have withholdings taken out. And you always want to make sure that you include their withholdings because unemployment compensation is considered unearned income. It's not money that they worked for.
Mhm.
So unemployment compensation does not go towards receiving earned income credit, which we'll discuss later on, but that's really important because a lot of people are under the assumption that they can just receive unemployment and still get earned income credit for their kids, and they cannot. They have to have earned income. They have to have income that they've worked for. Unemployment is just an insurance that the employer pays for.
So what if they have unemployment for a certain amount of time, but then they found a job?
Right. So they would get earned income credit for just the portion that they worked. But then it's also if they made too much money combined, it could phase out completely. So many nuances. So many. So Schedule 1, line 8A through Z, other income is entered here. Gambling winnings, if you're leasing your personal vehicle, jury duty. What else do we see? We saw some insurance payments, cancellation of debt. We do that a lot where a lot of people they're called 1099-Cs. Like say if they let a credit card go or a car go, and that company will send them a form that they had to pay taxes on for the difference of what they sold, say that car for versus what they still owed. And they're supposed to pay taxes on that.
Oh, wow.
But being that we're so smart, we knew a workaround. And so that's where our workaround goes in there. It's a cancellation. You have to put that income in there. You have to include it as income. And then on page 2, you subtract it out.
So, but not like if you had like not like a life insurance, but an insurance and you canceled them, they wouldn't.
So so in that case, we did
like
see
breast cancer, heart.
if those insurance policies were canceled and they sent you those premiums back, we have seen, because a lot of times those premiums will earn interest, we have seen people have to pay taxes on that interest.
So I have to be on the lookout for that then.
Yes, because that happened with something Slavic fire insurance that people had here in El Campo. The last 2 years they've been getting forms for those.
I did not know that.
Yeah. Gambling winnings, we do see a lot. A lot of people do go gambling and we get those W2Gs. All right, so any questions about that? Other income, any other forms of other income that y'all can think of that we may have seen?
You mentioned gambling, right?
Yeah, gambling, jury duty, scholarships. And if kids, I don't know how much. Don't tell me how much you received in scholarships, because technically, if it's more than what was
You're
paid for
paid for
tuition,
tuition.
it's taxable. I hear nothing, I see nothing. All right, so line 9 is, we're gonna total those numbers up. Line 10, you can combine line 1 through 7, you're gonna enter it there, and then it's gonna slip on over to that 1040. So let's do class problem session 3, exercise 4. Let's do that. Exercise 4. Let's do it together. Sounds good. Ready? We're gonna do it together. What? You already did it? So you weren't listening?
I was doing it when you were doing the other problems. That's why I told you to skip 6.
Yeah. Okay. So tell me, ladies in the back, what schedule and line of the income section of the 1040 the following should be entered on? I need my forms. Earnings from a savings account. Where does earnings from a savings account go? Right? So schedule B on the schedule B, and then it flows over to line 2. Line 2 what? 2B. Right, because savings account interest is going to be taxable. So we're going to take that 1099 INT. You're going to enter it on your schedule B. And then from the schedule B, it's going to flow over to line 2B, taxable interest. See? So it's going to go here. We're got 2B. But before, we're not just going to put a direct entry here. You're gonna go into the computer and you're gonna put it on. You're gonna click here. It's gonna take you to the schedule B. You put it on the schedule B, and then it flows here.
Okay.
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 Just so that you know where things are. Money received from the state when you're not working. Schedule 1, line 7. Sure. Do y'all see it?
She said 197.
Right. So we're going to go over, because it's additional income. You have to go over to your schedule 1.
Schedule.
And if you see on line 7, it says unemployment compensation. You're gonna change the form.
Okay. I'm glad you're recording so I can go back on.
Yeah. All right. This one's easy. The wages your employer reported to you on a W-7. I'm a W-4. I mean a W-2. Samantha, the wages reported to you on a W-2. Where does that go?
1A.
1A. 1041A. Remember when it was line 7? Remember when this was easy? And everything was on the 1040? Oh, yeah, it was on one form. Oh, those were the days. Okay. Income reported from a 1099 DIV. So a 1099 dividends.
That's right.
3A or 3B. So we're gonna put it first where?
3A.
We're gonna
Mhm.
first go into that Schedule B,
Oh, Schedule B.
and then, no, that's the bottom section of the Schedule B. And then it's gonna flow over here. It's gonna carry forward to the 3A or 3B, depending on whether or not it's taxable. Okay, you sold your car for profit. Sure. That'll work too. Line 7, a capital gain. It is technically a capital gain. Yes, she is correct. 'Cause remember we had that whole discussion. Yeah, I just went blank, Tish. Went blank. And 7. So you sold your car, you found out the difference of what your profit or your loss was. It's gonna go over on the Schedule D. And then from the Schedule D, it's gonna carry forward to here. Or it could go on the, that's a whole, that's, y'all ain't gonna do it. Yeah, cause you gotta, what is it, 47.97, then you gotta, then it goes to Schedule D, and then it goes, yeah. So, now, money you received from an apartment that you rented out. Schedule 1, line 5. And then what about jury duty? H. 8H. Do y'all see it? Tell me if you don't. You're gonna go on your Schedule 1. And your Schedule 1 has all the different forms of income listed. See that?
H.
8H has jury duty.
Gotcha.
Mhm.
So you almost have to know the forms to know when you're looking at.
You're gonna have to know where it
where
goes. Yeah.
Yeah. Okay.
Yeah, it's really important to know where it goes. And then you can always pull, I mean, you're looking at the computer, so you're seeing everything it looks line by line. Pretty much exactly. It's a clearer, it's bigger.
Yes, that's what.
I magnified as much as it can go that way. Retirement benefits from your employer. Where does that go? 1040 on the front page of that 1040 on 5A. And it's already 12?
Is it?
Wow. So wow.
We've been busy.
Keep trucking, huh? Social Security benefits. Where does that go? 6A. So on that 1040, you see it?
Right here.
Where does child support go? Nowhere. What do you mean child support? You don't get to claim it. You can't claim child support. You won the lottery. After you tell them, you lucky dog, you won the lottery, how much did you win? We've had some winners. I sure was hoping, who won, like, didn't somebody win like $2 million last year? Year before last? I sure was hoping they would come to the office. I did. I even put it out there. Hey, you won the lottery, you better come see me so I can tell you what to do with your money. All right. Alimony received. Where does that go?
2A. 2A.
2A. Right. And so if you see, look, 2A, you see 2B. It asks you for the date of the original divorce, decree, or separation.
Oh,
So,
to A and B.
so when you put in that date's going to determine whether or not it's taxable.
I missed one. You won the lottery. Where
You
did-
won the lottery. Lottery goes on Schedule 1, 8B. 8B. Okay.
I see it.
You see it?
Gambling.
Now we're just gonna do forms, just the
Mhm.
form. They bring you this form. So where is it gonna go? 1099 INT.
Schedule B.
All right, first you're gonna take it over to that Schedule B. So what is a 1099 INT?
Interest statement.
1099 INT is an interest statement. You're gonna get that from the bank.
From the bank.
1099G, where does that go?
Schedule 1.
Unemployment. So 1099G is unemployment compensation. And we see that all the time. 1099R. What is a 1099R? And where does that go? So it goes just 5A, 1099.
Retirement.
You can put it, honestly, you can put it both places and it's gonna go exactly where it needs to go. Okay, so 16, money paid to you by an employer who does not take out taxes. So first it goes on that Schedule C. And then from the Schedule C, it's going to carry over to the Schedule 1, line 3. And then Schedule 1, line 3. And then it carries over to that 1040. Money made from raising goats.
Schedule F, schedule 1, line 6.
So goats is a farm.
Right.
So it's going to go on the farm form, Schedule F. And then from the Schedule F, it's going to go on Schedule 1. Line. Schedule what? Line what?
6.
Oh, I'm hungry. Oh, here's a good one. Money made from a gas lease. So a gas lease, a lot of those come on they get royalties. They get royalties. So royalties would go on a Schedule E, and then it would flow from there. Schedule E. Schedule E, line what? Line 5. Line Schedule 1. It goes Schedule E, Schedule 1, line 5, and then 1040. So money made from selling items online. So Schedule C, and then it goes to Schedule 1, line 3. So selling things online would be like eBay, like if you're selling things on eBay, you're selling things on Facebook Marketplace, things like that. Like I have an eBay and I have a Poshmark. So I sell things online. So I would do that. And then finally, money made from the sale of stocks. Line 7. So if you need a Schedule D, you do Schedule D, and then it flows directly into your line 7. So that's just a 1040, right on the front page of the 1040. Yeah, 1040. Okay. That's session 3. Any questions? That's a lot of information. where are we in our headspace? Everybody good? All right, so it is 12:22. Do y'all want to grab food? Do y'all want to stop and grab something to eat and come back? Do y'all want to work through? Work through? Work through? All right, I need a snack.
I think everybody, please get done.
If y'all need a snack, let's get a snack.
I've been snacking. She brought her own snacks. Pass them around. Yeah.
What do you got? You already did it? I haven't done it yet. Okay, now you teach us part. Okay.
I'm listening.
I haven't done it. We're just gonna go off your answers then.
Well, was mine right? I'm guessing. Oh, wait a minute.
Oh my God. Oh, I had one open. Anybody want crackers? Mm-hmm. Mm-hmm.
Oh, that was getting smaller and smaller, girl.
Right.
¿Estás haciendo una lista? You right?
Okay, session 5, 4. 1B is 4. Session 4. So we're still on that schedule 1, but now we're gonna go page 2, schedule 1. So schedule 1, we're gonna do page 2, part 2. Y'all see it? It's adjustments to income. Adjustments to income, also known as above the line deductions. These are specific expenses that taxpayers can subtract from their gross income to determine their adjusted gross income. These adjustments are available regardless of whether you itemize and can influence eligibility for various tax benefits. They are reported in part 2 of the schedule 1. These adjustments are subtracted from your total income to calculate your AGI, your adjusted gross income, which can affect your eligibility for various tax credits and deductions. So, schedule 1, part 2, line 11. Y'all see it?
Mhm.
Educator expenses. Educator expenses are expenses that a qualified educator, which would be a teacher or coach, can deduct up to $300 in qualified unreimbursed expenses, such as athletic supplies for activities, books, equipment, and supplies needed for classrooms. This does not include paraprofessionals, so it doesn't include like the teacher's aides or the secretaries.
You have to be a teacher.
They have to be a teacher. Okay. And we do see a lot of this, and this is just a direct entry. We just go into line 11, they're a teacher, and you put in their $300. And that's it. And that's the max that they get. I know teachers spend a whole heck of a lot more than that.
Mhm.
Line 12, we don't see this. Certain business expenses of reservists, performing artists, and fee-based government officials. We won't see this one at all. Schedule 1, line 13, health savings account deductions. A HSA, or health savings account, is a tax deductible savings plan that allows the taxpayer to save pre-tax dollars for future healthcare expenses. So for 2024, the max contributions to an HSA is $4,150 for an individual, $8,300 for a family. So an HSA, which is basically your employer, is an employer provided plan. You put in X amount of dollars before tax is calculated on your paycheck into the savings account. And then in turn, throughout the year, you can use the savings account to buy medically related items. So you can use it for co-pays, for doctor visits. You can use it for prescriptions. You can use it at Sephora and Ulta and buy skincare products. Yes. I don't have an HSA, but I would be using ours at Ulta. So yeah, you can buy certain skincare products with your HSA. Line 14 are moving expenses. Now this is just for members of the armed forces. So we will only see it every once in a while. The only reason I've seen it the last few years is because my nephew was in the military and because my son's in the military. So we will see it, but it's not going to be very often. An active duty member of the armed forces is eligible to deduct certain unreimbursed moving expenses incurred due to a permanent change in station. This deduction is calculated using the form 3903. It has to be due to a military order. The deductible expenses are the costs associated with packing, crating, and transporting their belongings. And it also includes expenses for storing and insuring items within any 30-day period after the move from your old home and having them delivered to your new home. They can deduct the travel expenses, one-way travel costs for themselves and their household members, including lodging, but not food. So they can deduct the cost of the hotel, but not their meals. Standard mileage rate for 2024 for the moving expense is 21 cents per mile. So any expenses, any of these eligible expenses that the government has not already paid. So if the government, because the government does reimburse them for certain expenses, they'll move a vehicle from, they brought a vehicle from Hawaii to Texas, and we'll cover that expense. All right. The taxpayer does need to maintain records showing these expenses, receipts. Okay. Line 15, Schedule 1, line 15, deductible part of self-employment tax. So you remember how we were talking about self-employed individuals? Well, when we're calculating their income, that form is also going to determine how much tax that they're going to pay on the income that they've received. Well, this actually is a help because the self-employment tax, they're actually getting half of that subtracted from the income. So in addition to all the expenses that they've incurred, it's going to calculate the tax. They're going to get half of that tax as an adjustment to their income. So half of that tax gets subtracted from their income. So essentially, they're only paying half. So this is numbers taken from the Schedule SE. That's where it's calculated. The contract labor we spoke of earlier would have an entry on this line. The entry would be 1/2 of the self-employment tax computed on the Schedule SE. Line 16. Self-employed SEP, simple and qualified plans. These are like retirement plans for self-employed individuals. That's where you would deduct what was paid into their plan. I only have one client that has one. This whole time I've only had one client. Line 17, Schedule 1, self-employment health insurance deduction. A self-employed individual cannot deduct the amount he pays for health insurance for himself and his family on the Schedule C. So I'm self-employed. If I had my own plan, I couldn't deduct what I paid for myself and my family directly on my business expenses because it's personal for myself and my family. But I can take an adjustment on Schedule 1, Part 2, I can take I can't deduct the whole amount, but I can take a portion of what I've paid as an adjustment as long as I had profit. As long as I showed a profit that I made money, then I can deduct a portion of my self-employment health insurance, my personal health insurance here. Not employer paid, not like say I'm self-employed, but my husband works and he provides insurance for us. I can't deduct that. But if I paid for it cash, then I can deduct a portion of it. And y'all won't see it. Y'all won't see it. Line 18, Schedule 1, penalty on the early withdrawal of savings. This can be confusing. A bank will include this on a 1099. Box 1 will show the interest that you've earned. And had you not, if you took your savings out early, sometimes they will penalize you. And you can take that as a deduction, as an adjustment to your income. Line 19, A is alimony paid. So this is where the spouse who is paying alimony shows that he's paying it. Okay, it must be a pre-2018 divorce decree that has not been modified, and the taxpayer must include their ex-spouse's name and Social Security on the tax return. So this is a cross-check for the IRS. So husband is claiming it as an adjustment to his income, which means the spouse has to claim it as income.
So what if the wife refuses to give him the information?
It should be on the divorce decree.
Oh, okay.
As long as he has a copy of the divorce decree, it's on there. Schedule 1, line 20, IRA deductions. This is where you save for your retirement as an individual, not through a company. You're saving for your retirement in an individual retirement account or an IRA. You can deduct from your income as an adjustment $7,000. You can put in $7,000 if you're under 50 years old into your IRA, or $8,000 if you are over 50 into your IRA, and use that as an adjustment to your income. So you can put money into your retirement account up to $7,000 if you're under 50.
And 8 if you're over.
8 if you're over, and then you can subtract it from your income as an adjustment. It helps save on taxes. At the end, it helps reduce what we call your tax liability. And of course, there are other rules and stipulations to it. Schedule 1, line 21, student loan interest. This is a deduction where you can deduct the interest from student loans that you are paying on. The loan must have been an educational loan for college or vocational school expenses to the taxpayer, the taxpayer's spouse, or the taxpayer's dependent. The deduction applies for the first 60 months, the first 5 years. 60 months is 5 years, right? 5 years in which the interest payments were required. For 2024, the amount has remained the same, and taxpayers can deduct up to $2,500 a year. So you're paying back your student loans. The interest that you're paying back is a deductible expense for up to 5 years. And the max is $2,500. Line 22, that is used reserved. They can make as reserved in case the IRS decides they want to put something else in there. So it's just a blank line for future use. Schedule 1, line 23, Archer MSA deduction is a tax advantage savings account designed to help self-employed individuals and employees of small businesses cover medical expenses. So if I, as a self-employed person, wanted to open an MSA, I would just open a medical savings account, and then I could use that kind of in the same space as a health savings account. Schedule 1, line 24A through Z are just other adjustments like the jury duty that we were talking about. Other adjustments, jury duty pay, deductible expenses related to income reported on 8I from the rental personal property. Non-taxable amount of the value of Olympic medals. We're not gonna see that. Attorney fees we paid in connection to an award from the IRS. Stuff that we're just not gonna see, okay? So, Schedule 1, line 26. You're gonna add those lines up. These are the adjustments to your income. That carries forward over to the 1040, line 10. So all of those adjustments are what's gonna get subtracted from your gross income. Okay? So going back to the 1040, line 10, adjustments to your income from Schedule 1, line 26. Line 11, you subtract, like we were just saying, you subtract line 10 from line 9. After subtracting your total adjustments for your total income, you have what is called your adjusted gross income, or your AGI. And that might be something that you hear a lot of. You might get called randomly one day and say, hey, Miss Denise, can you look at my last year's tax return and tell me what my AGI was? That is hint that they're doing their taxes on TurboTax, and they need their AGI. Yeah, I tell them, if you bring me $50,
Yeah, $50, right?
yeah, you bring me $50, I'll give you a copy of your tax return.
So you don't give it to
No.
them?
No.
No, ma'am, we sure don't.
Oh, okay.
So if somebody calls and says, hey, I filed with y'all last year, can you give me my AGI?
But they should have their copy.
They should have a copy of their tax return, and it's on the copy of the tax return. We don't tell them where it is on the tax return. They've got it, what line number, they can find it themselves.
Oh, okay.
They should have
If they don't have a
copies.
copy and they want a copy, I'm like, well, if you've lost a copy of your tax return, you'd like another copy, it's gonna be $50. What do you mean it's gonna be $50? $50.
I'm gonna call Denise.
Call Denise, she's gonna tell you the same thing.
Okay.
Mm-hmm.
I'm good to know.
Yeah.
It's good to know.
So copies of previous tax returns are $50,
Okay.
regardless. Now, we'll make exceptions, like if they need it for immigration or another special circumstance, they need it for a mortgage.
What if your house
School.
burned down and you've got your records?
And you need your
If you
records for purposes of, then of course it'll be free. But you tell me you're doing your tax on TurboTax, I'm charging you $50.
They will.
And they'll tell you, I'm gonna do it on TurboTax. Okay, $50.
Or you should have your own
Or you
copy.
should have your copies.
Yeah.
And sometimes they just don't want to look for their copies,
Mhm.
and they just want, well, hello, that's manpower.
Yeah.
you know?
You don't know if I'm busy. You don't know what I'm
Right,
doing.
exactly. So it's $50. But we tell them when they sign their customer letter that additional copies of their returns are $50. It's in
It's in there.
it's in there. So if they read it, that's up to them. Yes, they have to initial it. Mm-hmm. And we'll go over all those forms. That's in that 28th. On the 28th, we'll go over all those forms. So if you hear somebody referring to their AGI, that's what that is. So, but this is the point that we have to come to so that we can calculate the tax. So we can determine how much their tax is. This is the fun part of the class. Not really. So, potty break, good. Keep going. We're almost, literally, we're almost done. So, yeah, so we'll probably finish this today. Okay. You still good, Sam? Any questions? Did you take a potty break?
Yes,
on
ma'am, I'm okay.
us? Okay. Like, did you take a potty break on us? All right.
No.
Okay, we're moving into session 5.
Wake up, mamas.
Computing the tax. And let me know if I'm going too fast or if you need something, okay?
Yes, ma'am.
All right, computing the tax. Before we get into computing the tax, there's one issue that we need to really be aware of, and it's something that we've discussed earlier, and that's date of birth. It's very important. Our computer programs, what is that? Does it stand up? Oh, my sciatica. The computer program always asks for the date of birth of not only the taxpayers, but of all their dependents. Someone's age can make a big difference on a tax return. And the IRS has his or her date of birth on record with the Social Security Administration. The IRS cross-checks the date of birth information with the SSA. And sometimes the SSA is wrong.
Yes.
And with electronic filing, sometimes we'll have to file with the wrong birth date. We'll have to file with the birth date that the Social Security Administration has until the taxpayer gets it fixed. It's happened, not often, but it's happened. So until they fix those records, we have to file with the wrong birth date. So the 2024 standard deductions, these always change with inflation. Cost of living always changes these standard deduction rates.
Going
They're gonna
back
be
real quick.
Uh-huh.
So when you're putting in the birthday, does it pick Social Security, pick it up right away, or does it come back after?
After we send it to we send it to our filing center. Filing center sends it to the IRS. IRS cross-checks it. And if it's wrong, then they'll send it back to us.
And then you have
And
to
then we
fix
have to
it,
correct
so
it.
there's a delay
Right.
on, okay.
Most of the time we can fix it, like say if it happens during the day, because we'll send tax returns throughout the day. If it happens during the day, we try to fix it right away and resend it. If we can't get an answer back from the taxpayers, that's where the delay comes in. Yeah. So if we're like, hey.
But either way, you've got a copy of their social and their
And their
IDs,
dice.
and you're double checking.
Right. And then, and it happens. Sometimes there's a typo. And okay, well, I typed in 74 and it should have been 64, whatever. We fix it and we resend it.
Okay.
Cases like that, we don't have to call the taxpayer. We just fix it and resend it.
Right.
But if it's something that's completely off, say they didn't, because sometimes they don't have Social Security cards, and we have to go by their word. And they transpose the number when they told us. So then we have to get clarification from them.
Okay.
All right, so single, married, filing joint, the standard deductions are $14,600. Married, filing joint, qualifying widower, standard deduction is $29,200.
That's good enough too.
Yes. Head of household, standard deduction is $21,900. And if they're over 65 and or blind, then you add an additional $1,950 to those. Remember, they're so high because we no longer get exemption amounts.
So we're all gonna have like 2,500.
Yeah. And it'll go up again next year. And then we have no hope of things going back to the way they were.
They increased by 2,500.
We were hoping that
How about that 55 over additional?
that's always been there. It
You
goes.
add that?
Hmm?
You add that?
The computer adds it.
It adds it.
It adds it in automatically. Once we put in their birthday.
And if we click that they're blind, it'll automatically.
Yeah, but because the 2017 Job Cuts Tax Act standard deductions doubled, and they did away with exemption amounts. So we used to get 4,000 something per exemption per person on your tax return to bring down your gross income. Well, they cut that out thanks to not my favorite person in the whole world. And they doubled the standard deduction. So we were hoping we were going to get a new administration next year when this phased out. It was supposed to be over in 2025. They're probably going to extend it now because this did not help middle class and lower class. This helped the upper class. It helped the rich.
Yeah.
Yeah. They took all the deductions. Yeah. So this is why it's very important to vote. So line 12A is where you would enter the standard deduction. Your standard deduction or your itemized deductions from your Schedule A. So we're not going to go into the Schedule A, but just briefly, your Schedule A is where you itemize your deductions. This is where you would take things like your mortgage interest, your property taxes, state taxes, Gifts to charity, donations to church, medical up to it. There's some limitations there, but it's your medical expenses. What else? Because they took so many things away. We hardly use it anymore because they've taken so many things away. Sales tax. Yeah. So all of that has to be more than the standard deduction that they give you. So if your itemized deductions are not more than your standard deduction, there's no point in using it. And with the standard deductions being so high, it's
You're not
rare.
sure.
It's very rare. Because they've even put limitations on the amount of property tax that you can claim. So it's just wasn't for us. We'll just say that it wasn't for us. So you will be reducing your adjusted gross income by either your filing status deduction or your itemized deductions. So it says, let's take a quick look at the Schedule A, but we're not going to do that because I didn't print any out. But if you look also on the 1040 on the side right here of that page 1 of the 1040, it has a little chart too that shows what the standard deductions are or what the amounts are. All right. And then line 13, qualified business income. So when you're doing a Schedule C, if you meet certain parameters, you are also eligible for other qualified business income like deduction, and that goes there. Computer does it for us. We don't have to. I love the computer. We don't have to do it. The computer does it for us. All right. Line 14, we're going to add line 12C and line 13, and then we'll subtract that from line 11 to get our taxable income. And the taxable income, that is what we're going to use to determine the amount of tax that they have to pay. So I also gave y'all the tax table. So the amount, that taxable income, you're going to go over and you're going to look up the tax based on their filing status. We'll determine how much, what the tax is owed. Or the preliminary tax.
Does it matter that 2023?
No, it doesn't. Well, not for teaching purposes. It's this. The taxes are different, but the way that we figure them out is the same. So line 16 is the tax. If you look at the back of the folders, you'll find a set of the 2023 tax tables. And so let's just kind of look over that. Flip to the page 3 of that tax table, and it identifies itself as the 2023 tax table. You'll see right there. Yeah. Okay. So you'll see where it says if line 15, the taxable income is, and then it has at least, but less than. Y'all see that in the columns? It has, you see that right here where it says at least but less than. See it, Nancy? Okay. And then you also see where it says single, married filing joint, married filing separate, and head of household. And then it has your taxes. So if your income is at least, we'll go down $200, but less than $225. So if your taxable income is in between those, then you scroll over and underneath their filing status, that's going to determine how much their tax is. So let's do $10,000. So flip a page over, and taxpayers' taxable income is $10,130. Okay. $10,130 is less than $10,150. Y'all see that? Between $10,100 and $10,150. And that taxpayer is head of household. All right, so we're gonna scooch over to head of household, and their tax is $1,013. So on that $10,130 taxable income, their tax is 10%, $1,013. Do y'all see that, everybody? Okay, so that's how you look. If we were going to physically look up the tax and determine what their tax is, that's how we would find it. We would look the income. It's at least this amount, but less than this amount, and then by their filing status. But like Tish said, the computer does it for us. We just need to know. We just need to know.
Right.
We need to know how. We need to know why. Thank you, computer. Yes. Okay. So that's that. And for class purposes, in our exercises, you will be finding the tax on a few problems. Okay. So additional taxes. Of course, there's more taxes that we have to pay. More than just the taxable income, because we did all this other stuff throughout our lives. We had marketplace insurance, or we had, we pulled out retirement. So there's other taxes that we might have to pay. So to determine that, we're going to go to Schedule 2. Schedule 2, which is also 2 pages. Additional taxes. Schedule 2, additional taxes. So Schedule 2, line 1, is just additions to tax. And so this form has changed from previous years, guys. I don't know if y'all, I didn't realize it until I printed it out and I was looking at it, I was like, what the heck?
We're always changing. forms.
Yeah, so it's
I don't
changed.
know where we're at.
So Schedule 2, line 1A is excess advance premium tax credit. What is that?
Oh, man, that's what we're doing.
The premium tax credit helps pay premiums for health insurance purchased from the health insurance marketplace. So the marketplace insurance, otherwise known as Obamacare. And then as another note, a lot of people don't realize that Obamacare and marketplace health insurance are the same thing. They are the same thing. Obamacare is just a nickname. It's the marketplace healthcare insurance. If advance payments for this credit were made for the taxpayer, his spouse, or his dependent, the taxpayer must complete Form 8962. So what that means is, for lower income taxpayers, the government will pay a subsidy. So they will pay a portion of those premiums on behalf of the taxpayer. The government does that, it has to be reported. Okay, so if the advance premium credits, if that subsidy was more than the taxpayer can claim, the taxpayer must enter the amount on Form 8962, line 29. If the taxpayer purchased health insurance through the marketplace, we would need a 1095A. So marketplace will send a 1095A, and it shows, it has the different columns. It shows what the premium is, it shows what the premium is, what the subsidy was, and their total cost. So we have to put those numbers in. If the taxpayer's income is more than what they reported to the marketplace, they are going to pay a tax. They're going to pay a tax on that subsidy, on a portion of the subsidy. So if they have marketplace and they don't tell us they have marketplace, that return's getting rejected and sent right back to us.
Sometimes they don't even know. Remember
Sometimes they don't know they
last
haven't.
year?
Sometimes all they've done is inquire about marketplace insurance, and they've gotten signed up, and they don't even know they have it. That happens a lot. But go ahead.
But don't they send you forms and stuff that
Supposed to.
They're supposed
They're supposed to, but
Yeah.
if whoever signed them up didn't get the address correct,
Could be going somewhere.
It's gonna go someplace else.
At the farming center, where was that man who did it with FBN, Mr. He got the letter finally canceled that, but the guy was just re-signing them up
Over and over again.
And they got a lawsuit finally against him.
Yeah. Oh, that's good. Yeah, because that happens a lot.
When I lost Vicky, I lost my income and I had to call Marketplace, or I didn't call them. Something happened in the middle between losing Vicky. They charged me $900.
Yes.
I had to fight with them to get my money back.
Yeah, they do. I mean, and then you have to pay tax.
Mhm.
All right, so Schedule 2, Line 2, Alternative Minimum Tax. This is a completely separate tax system designed to ensure that high-income individuals, corporations, and trusts pay at least a minimum amount of tax. They don't. Even if they qualify for many deductions or credits under the regular system, the AMT was created to prevent wealthy individuals from using excessive tax breaks to pay little or no tax. For most taxpayers, the AMT is not an issue, but higher earners or those with specific tax situations may need to calculate it. Now, this is a lot. The AMT has been hitting a lot of people who would be considered middle income. So a lot of people that might hit the 100,000 mark or the 150,000 mark have been hit with the AMT. Or ATM, AMT. I put yeah. So it's essentially the uber wealthy are not being taxed. It's the middle class, the middle income who are getting hit with these taxes.
Wow.
So Schedule 2, Line 3, you're going to add lines 1, 2, and you're going to enter here, and then it's going to flow over to your 1040. All right, so that's one portion of the taxes. And then on that 1040, we're just going to do some addition. So line 17, you're going to bring over that amount from line 3. We're going to add 16 and 17. Line 19, non-refundable child tax credit or credit for other dependents. What does that mean, Denise? What does that mean? Child tax credit is a minimum credit of $2,000. It's available for each qualifying child under the age of 17. $1,500 of which may be refundable. So refundable and non-refundable. A non-refundable credit, child tax credit, only helps reduce your tax. Okay? Just helps bring down the amount of tax that you would owe. So say a taxpayer owed $2,500 in tax, but he had a child tax credit of $2,000. It brings down that tax to just $500. Okay? A refundable tax credit is a dollar for dollar credit. So if he had $1,500 of a refundable credit, he's going to get an additional $1,500 on top of whatever, say, his withholdings was or any other credits. So there's two types. There's refundable and there's non-refundable. The credit is phased out when your income becomes too high. No minimum income amount is required. A qualifying child of a tax is a taxpayer's dependent, lineal descendant, or foster child under the age of 17 at the end of the year. Once that child turns 17 in a tax year, child tax credit is over. So they could have been 17 for the majority of the year, or 16 for the majority of the year. Mm-hmm. They turn 17 in November, December, October, September, they lose the child tax credit. Okay, so 17 and under. Under the age of 17, sorry. Other dependent credit. The other dependent credit is a credit for other dependents. It's a $500 personal tax credit. The credit is for $500 for each qualifying dependent. The credit is non-refundable, so it just helps reduce your tax. Phase out begins for taxpayers with an AGI, adjusted gross income, of $200,000 for individuals and $400,000 for joint filers. The phase out applies in combination with the new child tax credit. Unlike the child tax credit, the dependent does not require valid social. They can have an I-10 or an ATIN, which is if you're adopted a child and they get a temporary card. So other dependent credit would be for your child who is 17 years or older. If you've claimed mom or dad on your tax return, they would get that other dependent credit. Or the taxpayer who has his family in Mexico and they have I-10s, he could get that other dependent credit. Or said they're here and they have the I-10s, he would get that other dependent credit. And it's just $500 to reduce your tax. So line 20 is the amount from Schedule 3, line 3. Oh, so many schedules. Schedule 3, line 3. Ooh, let's just not look at that. Yeah, let's just put a line through that. That was a typo. All right. So now we're gonna go over. We're gonna pop back over to Schedule 3, and we're gonna look at non-refundable credits. Did I screw? Oh, right here. I'm looking at Schedule 2. Schedule 3, non-refundable credits. So Schedule 3, line 1 is a foreign tax credit. We see this every once in a while, and most of the time it's like $2, $3, $4. I mean, it's not a lot. Foreign tax credit is when the taxpayer was required to pay taxes to a foreign country on income. He has also included this on his tax return if he or she meets certain requirements. What was the requirement? It was a few $100s, wasn't it? It's like we had one person. It's like $120. It's a form. It's an 1116. If they have income of over a certain amount, then it has to go on this form. If it's under that amount, then it doesn't have to be included at all. It's a weird amount. Schedule 3, line 2, credit for child and dependent care expenses. So, credit for child dependent care expenses. The babysitters. When you're paying your babysitter. So, a qualifying person, if you're paying to have somebody watch your child, that child must live with you, the taxpayer, in your home. The taxpayer must pay over half the cost of keeping up that home. 2, the taxpayer must have earned income for the year. Okay? Or both. If it's a married filing joint return, mom and dad have to either both be working, or if mom and dad are both not working, to be a student, or they have to be looking for work, actively looking for work in order to claim that child dependent care credit. Okay, so mom and dad are paying a babysitter to watch their kids. They either have to both be working or going to school or looking for work. So if dad's working and mom's at home and she's not doing any of that, then they don't get that credit. But if dad's working and mom's going to school, they can qualify for the credit. Or if dad's working and mom is looking for work, they can get that credit. And in reverse as well. Dad can't be a stay-at-home dad, and then they also send the kids to daycare, which some people do. She's not working, but she still sends the kids to daycare.
They got one even.
Yeah, they have money so that she can have free time. Well, they don't get to claim that credit. A qualifying individual, so the child has to be under 13. So they need to be 12 years old or younger in order to receive the credit. You can send them to daycare, but you're not gonna get credit for them if they're 13.
Okay.
Okay. Unless there's always an unless they are disabled.
Right.
And if they are disabled, it can be either your dependent or your spouse.
Mhm.
And you can get the credit for it. The maximum qualifying expense is, and I didn't know if I updated this part. I don't know if I updated it, but there is a max. My book says $3,000 for one individual and $6,000 for two or more, but I want to say that that is not correct. Let me see. GPT. No. It is, okay, so child dependent care credit can offset expenses. For 2024, the credit covers 20 to 35% of up to $3,000 in child care related expenses for one and $6,000 for two or more. Translate to a maximum credit of $1,050 for one dependent and $2,100 for two or more. So 3,000 or 6,000. So I did. Okay. I need to go to the restroom. So I'm going to pause it. Tish, if y'all like to continue, you can take over, or y'all can wait. It's up to you. I'll be right back.
Take over. You're gonna skip the page. Okay, Schedule 3, Line 3, education credits are two separate credits available to the taxpayer who must choose which one is more advantageous if they qualify for both. They are both computed on Form 8863. Okay, so this is going to be when you go to college. So you're gonna get like a form called a 1098T. And they qualify for this credit. They'll have like all their information on there. If they're there, the max for this is gonna be 4,000. If they, look at how many years? If they haven't claimed it in the past 4 years, so they can only claim it for 4 years. Otherwise, it goes to a lifetime learning credit on the 8863. If it's after the 4 years, and then there's certain things you have to ask them, like if they're a felony, if they claim the credit, if they have to be full time to receive the, but it's only tuition and books that go for this credit. Nothing else, not like computers, laptop,
It's tuition, books, or any required supplies. So if your professor says you have to buy a lab, like Mimi had to get a lab coat for class. So then her lab coat is a deductible expense. Shots, like if you're doing the nursing program, you have to get the shots, the mandatory shots. Right. Those things, if they're required supply for the class, then it's a deductible expense. But if it's not, then it's not. And then where did you stop?
So how do y'all know if it's required or that?
We have to take their word for it. We have to take their word for it, or if we want to be shitty about it, we can go look it up, or we can have them required to bring us proof.
Yeah,
that is requirement.
we not only take the word for it, they have to have that 1098 together.
Right. Right. So
If I say, hey, I went to school, can't
we
do anything unless they have that.
right. So if they don't have the 1098T, we're not calculating that. We're not calculating that credit anyway.
Gotcha.
Okay, there was some that like they were at the barber shop that didn't have the 1098.
Then they wouldn't do the American Opportunity Credit. They would do the lifetime learning credit.
Okay.
And then you have to have a receipt.
Yeah, and then get their
Because that Genesis training too. Oh, and I got on the phone with her one time too. Yeah, she was a pill.
yeah, I know, I used to deal with that in the newspaper.
Yeah, she just thought she knew everything. I don't need, it's like, yeah, the IRS is requiring it. So, you know, it'd be nice if you gave your students, but, so where'd you stop, Tish?
Where the lifetime learning credit, American Opportunity Credit.
Okay, so there's two different types of credits. There is the American Opportunity Tax Credit, which is calculated as a maximum of $2,500 per eligible student, and 40% of this credit may be refundable. So 40% of that may be $1 for dollar. It's only available for 4 years of post-secondary education. So it's only available through their bachelor's degree. And an eligible student can only have it for 4 years. They cannot be a felony. They cannot have a felony drug conviction. So we have to ask them, how many years have you been in school? Have you ever been convicted of a felony? Have you ever had a drug felony conviction? Now, they're gonna tell us the truth?
No.
We don't know. I'm not gonna go look up.
Mm-hmm.
So, but we do have to ask them, because if they do have a felony drug conviction, then they're not eligible for the American Opportunity Credit. It has to be a lifetime learning credit. It has to be the other smaller one. It still can get something, but it's not going to be the nice big one. Okay. The second is the lifetime learning credit. This is a maximum of $2,000 per tax return. The credit is limited to the amount of tax you would pay on your return. So if you only had $15 in tax, your lifetime learning credit is only going to be $15. It's not going to be any more than what the tax that you have is. The credit is available for all 4 years, all years of post-secondary education, and all continuing education for improving job skills. So I continually take classes all year. So anything that I pay out of pocket for my classes, I can take a lifetime learning credit for. Say Tish wants to go back to school and go do accounting classes. It's improved her job skills. So she would be eligible. Say she's already done her 4 years. She would be eligible for a lifetime learning credit. Somebody wants to go get their master's. They've already done their 4 years. They already got their bachelor's. They want to go do their master's. They're eligible for a lifetime learning credit, and not the big doozy one. There used to be another one. It was called the tuition and fees deduction. That one went away with Trump ass. And that one was a good one too, because there are income limitations to both of these credits. If you make too much money, you're not eligible for these credits. It's like $180,000 phase out. 90 for individual, 180 for married filing joint, and then they phase out to where you just eventually don't get any credit whatsoever. And this one is a big one. So this one, just keep in mind, they do need that 1098-T. We do have to ask them these questions. It would also be helpful if they had the receipts to support that 1098-T, because sometimes they receive scholarships and things. And then the max that we can put into the system for American Opportunity Credit is $4,000. It won't let us put in anything more than that. All right. So moving on. Schedule 3, line 4, retirement savings credit. I wonder why I have an asterisk there. This is calculated on Form 8880. You may be eligible for this credit if you or your spouse, going married filing joint, make contributions to a retirement plan. You may take this credit if you were a student or made any withdrawals from a retirement plan. So, I work at Nanya. They have 401k. I contribute to the 401k. I don't pull any money out. I'm not a student. So I am eligible for the retirement savings credit. So the government pats me on the back, gives me, it's normally like what, $100-something credit for contributing, for being proactive and contributing to a retirement plan. They say, good going, and they give you a little bit of a credit for that. Now, if you withdraw any money from there, then that credit is gone. If you are a student, then that's gone. So, Tish, dang, she shit the stick and She signed up for accounting classes, so now she can't take that credit.
You get charged twice, taxed twice, right, when you take it out?
No.
And then when you do taxes?
No, you don't get charged twice. You pay your taxes, you pay your federal withholdings on it. But then if you take it out too early, you have to pay a penalty.
Penalty. that's
So
what I
it's
meant.
two separate.
So
It's
you
two.
pay penalty and then you still get,
Well, you're taxed because it was pre-tax money. It was pre-tax when you put it in there. And then if you pulled it out before 59 and a half, you're gonna have to pay those taxes back because you weren't taxed on it the first time. And then you pulled it out too early, so you're gonna be penalized.
okay.
Unless there is an exception, because there's always an exception to things. Yeah. And those are fun too. All right. So, any questions so far? Good, everybody? Okay, so line 5, schedule 3. These are for things like solar panels and wind turbines. I don't know anybody who has a wind turbine in their backyard. Solar panels are a scam.
Yeah, I did, well, we had a film that happened.
Oh, these poor people, they think that they're just going to get all this money back, and you do not. You do not.
And then they tell them they're gonna get so much credit, and that was one person, well, where's my, good? You could only get so much.
Because of your taxable
They don't
income,
give it-
yeah.
They don't give it to you all.
And then depending on what your taxable income or your tax liability is, you're only going to get so much. So, other non-refundable credits, 6A through Z. Others just that any credit not specifically named on the other lines, like the qualified energy, electric vehicle credit, and adoption credit. We do see that every once in a while. I did do a couple of electric vehicles last year, I think, and then I've done a few adoption credits. So you do run into some of these things. And if you do, somebody asks you about them, you just ask your office manager.
Right.
Okay. And if y'all have any issues, y'all just call us. We might be able to talk through Zoom. Okay, so line 7, schedule 3 are other non-refundable credits. And then line 8, schedule 3 is just addition lines. And then you carry over that to the 1040. So let's do class problems. 5. We already did. Yeah, 5 and 6. I think I messed that up, huh? I think it's 4 and 5, right? 6. We already did 4. So we're gonna do adjustments and computing the tax. So we're gonna do 5 and 6. Ooh. 6 is a doozy. Did you do these already? All of them? 6 too?
Been 6 and forever.
I know. We always skip 6. We're like, nah.
We will stop at 5. Like 6 and 7 are like our actual math.
Yep.
Mathing.
Math.
That's what I'm like.
She's like,
Math today?
yeah, we're mathing today. We'll do 5.
Okay.
Y'all do 5, we'll do 6 together. Let me eat some crackers because I'm hungry. I gotta send an email. Huh?
This is so nice that the computer does.
Mm-hmm. And then a lot of this will come together once you start doing things in the software. Mm-hmm. Okay, we had a, are we at a,
No, ma'am.
no, okay.
or we can go on. I just feel like I have to
No, go ahead.
more.
I'm doing it too.
Like,
I didn't do it either.
like I understood everything you're saying. When it comes to trying to look for it, it's like, okay.
Oh yeah, trying to apply it
Mhm.
because it's a lot of back and forth. It's a lot of different
Mhm.
forms. Do you read number 9? Alexander Hamilton.
Oh, the other one. I need to go past that.
Did y'all upgrade to Sparklight? Not Spotlight.
Right?
Rise. How do y'all like it?
Okay, so we're the internet at the house.
To Rise?
We only had one day when it went out.
Mm-hmm. I think I only had one day too.
My son was thinking of that one, changing.
Mm-hmm. Yeah, we changed. When was it? Last month sometime? Okay. Let's go over exercise 5. I'm so hungry. So exercise 5. We're going to indicate on what schedule and what line of that schedule you would enter the following information. You received a form from the trade school you attended showing how much interest you paid on your loan. What schedule and form? What schedule and line? Yes, you're right. I messed up.
Schedule what?
Schedule 1, line 21.
Schedule one.
Mhm.
line 21.
I read 1098T. I only wrote the things I didn't. Schedule 1, line 21. So that's student loan interest.
Why did I find 319? What did I go into?
You said 19?
Mm-hmm.
Alimony?
No, not alimony. Lo olvidé.
Yeah, because 19 is recapture of EPE. Yeah. So schedule
So schedule 1.
schedule 1, line 21.
So this is not. See, I had 21 on there on the side.
Mm-hmm.
So
Okay. All right. So you have your own business and pay out health insurance premiums for yourself and your family. Schedule 1, line 17.
okay.
Mm-hmm. You started saving for retirement with an individual retirement account. Mm-hmm. Schedule 1, line 20. You are divorced and must pay alimony to your ex-spouse. 19A. Schedule 1, line 19A. You are self-employed and had to pay self-employment tax. Mm-hmm. Schedule 2, line 4. The cost of moving all your household goods from your company transfer. All tests are met. So, yes. You cashed out your savings account, and therefore the bank assessed the penalty. Yep. Schedule 1, line 18. You opened a medical savings account. No. You opened a medical savings account, not a health savings account. An MSA, medical savings account. Schedule 1, line 23.
What line?
Schedule 1, line 23. Mm-hmm. It's medical, not health. Health savings account is for an employed individual. Medical savings account is for a self-employed individual. You are a teacher. Schedule 1, line 11. Any questions? Medical savings account. Mm-hmm. Schedule 1, line 23. The medical savings account, MSA.
I missed number 6 and 7. The audio cut out on my computer.
Okay, so number 6, the cost of moving all your household goods, schedule 1, line 14.
Okay.
Line number 7, you cashed out your savings account, and so the bank assessed the penalty. That is schedule 1, line 18.
Thank you.
You're welcome.
That's because self-employed. Self-employed. I mean, self-employed. And health savings.
All right. So any questions on those?
More practice.
More practice? Okay. I'll be back. I need another Dr. Pepper.
No.
But self-employed.
And then line 13 is for health savings account.
So what we see is health savings account, is HSA, because that's from a company, from an individual. I mean, a company's putting aside for their employee.
And so medical savings account is from an individual.
It's an individual, it's a self-employed individual.
So you,
Me.
or anybody that has a business.
Threw y'all under the bus, huh? Ha ha. Gotta be quick on your feet. Okay. So now the fun one. I don't know why I keep opening it first and then putting it in my sleeve. I keep doing that. All right. So now we're going to compute the tax. And so we're doing this a little bit different than what we normally do. We're going to determine the filing status of each scenario. We're going to determine their taxable income, and then we're going to go calculate the tax. Okay, we're going to do all three. We're going to put everything that we've learned together. All right.
You know, when I crave for Dr. Pepper or anything sweet, I know my sugar's high. When I don't crave it, like I can see things like, then I know I'm at a normal. When I start craving sweets,
Yeah. See, I don't really, because that's zero sugar. So I don't really eat a lot of sweets. Like it's mostly, if I'm going to eat a lot of sweets, it's mostly chocolate, but at my time of the month. And then that's it. Other than that,
what is your A1C at?
it was 5.2 or 5.2.
Wow, that's great.
That is good.
Yeah.
Mine went down from 19 to a 12, and now I'm down to 9.
A 19.
I was hitting 600. I was my meter wouldn't even read. I was
Oh
hitting
my
way over.
goodness.
Yeah. They're like, why are you still walking? I was like, I've got it down to 9.6.
That's good.
So
That's good.
this is, and then they added the insulin, so that's not good.
Okay.
So and now I know the difference when I start craving. I'm kind of high. If I look for anything sweet,
Yeah.
okay, I'm getting up there.
Oh.
Pizza, portions of pizza, and I love pizza. It shoots me straight up to 400.
Ooh, okay. All right. So we're going to compute the tax. All right. So for each of these situations, we're going to determine their filing status, their taxable income, and then their tax. So you will need a calculator or your phone. And we'll do it together. Let me get my tax table off the back. Yeah. I can't think of it.
That's like good.
I know. Y'all know how it is. All right. So Bob and Mary Jones are married and they have one child. Their adjusted gross income is $54,145. What would we determine their filing status to be? Married filing joint.
Mhm.
So if they're married filing joint, their adjusted gross income is $54,145. So we would have to subtract their standard deduction from that, correct? What's their standard deduction? 27,700. And we get,
26,445.
so we're just assuming that they don't have any other credits, any other anything. So their taxable income is $26,445. That's what we're gonna try to determine their taxable amount, what the tax they're gonna pay is, right? So we're gonna go to the tax table and we're gonna look up 26,445. So 26,000. We found the column that says 26,000.
Mhm.
Now we're gonna look 26,400. Between 26,400 and 26,450.
Mhm.
Then we're gonna scoot across to married filing joint, correct? And their tax is, do we see that?
2731.
$2,731.
So that's her filing status.
Their filing status is married filing joint.
Okay, the 27.
The 2731 is their tax.
2730.
Excuse me. We're still, yeah.
731.
No, well, their filing status is married filing joint,
Mhm.
and then their
Okay, oh,
tax, yeah,
Mary
is married filing joint. Their taxable income
is the 20.
is 26,445.
The one we just.
Yeah, so when we just looked up, and then their tax is 2,731.
Okay, I got it. 27.
Okay, so we'll do the next one together. The next one is Robert Gonzalez. Robert is divorced and he lives by himself. His adjusted gross income is $65,782. What's his filing status? Single. And then his taxable income? Okay, so we're gonna take that AGI and we're gonna subtract the single standard deduction of $13,850. And we're gonna get $51,932. Everybody see how to figure that out? Okay.
So he is single,
Mm-hmm.
138050.
Right. You're gonna subtract it from his AGI.
Minus- minus 15. It gives you 51,932.
51,932. Mm-hmm.
And that is.
Okay, and so then that's what you're gonna look up as a tax, the 51,932.
Oh, wait. You're single.
Okay, so did everybody come up with $6,731? Okay, so, y'all do the next two. And then we'll go over them and then we'll go. Jesus. My tripas are eating each other. Tomorrow's shot day. Yeah, I'm hungry. It's a thinker. It's a thinker. You have to determine which. Uh-huh. I know what I would do.
What do you wanna know what we wanna do?
What's going to be the best scenario for the taxpayer? Best scenario for the taxpayer. Legal scenario.
Yeah. Throw that in there right quick.
Yeah.
I know what I would do.
Did all the math and now, so now I'm going to go back and go do did all the math first. Now I'll go find the tax.
Hmm. That last one don't seem right to me. Oh, man, son.
Can I trick you?
I've been using what's in here and not going to look for it. That's when nothing seemed right.
Oh,
I just caught myself that last one didn't seem right. And
Uh-huh.
it's because I'm not going into here.
I did all the math first, and then I went through, and now I'm finding the tax.
Oh,
I did all the math part.
okay.
Well, that's the longest.
Yeah. I can just, Loca. Okay. Let's go. Well, what I can do is because I did that was that and came out with this amount, I just go into the 14 and get that. Okay,
Mhm.
I'm good.
Okay.
I'm good. Just go back and look and because I've got the answers here, I just gotta go and find them.
This one. And this one. They're both negative.
Yeah, he's a student.
Parents don't pay him.
So
So this,
we,
so then that, the AGR.
Remember this one?
This one. She's had a household. Her tax will be done. Her AGR should be 13,000.
No, I see her, I see myself.
This one.
And a lot of information. Yeah.
So you'll be able to go back onto YouTube.
Everything again.
We go off of that one. That's the sense. That's the one. Okay, that's not. Because he's a dependent.
Right, correct. Wait, can you read it? It's just a chart.
Oh, she didn't give us the table.
No, all it's asking is if they're eligible for it.
Oh, okay.
Yes or no. It's a yes or no question. So you're just gonna use that chart to determine.
we done that.
Right.
Oh,
That's our last section.
So we'll probably come back to the
Just like you said, it was not.
Yeah.
But completeness,
more of the making.
unless you want to look at it. I'll make it. Whole project. The last 3 weeks for taxes. This is it, though.
I know.
It's gonna stay like that till October.
No, it's not, you're gonna change it again this year.
I like the project, but I don't like
She was different sizes, like this one she bought us.
it. Just like that. I bought extra small, I bought.
Yeah. That's in my idea, right?
On your running room and my dining room. Back when I was. I did it 29 hours. Do the living room and 7 in the dining room. There's a little pantry by hand.
Yeah, Hanson, yeah, you were automatic.
Yes. Moved down. Our trailer. Was parts of my sick line. It might have. Ended up moving back to this home. Extended it again. And they did like a park.
She said she likes it.
Now,
Yeah, my friend said she was wearing
Right.
Oh.
Well, we can look at my cart. All right.
Where's them at though?
Amazon. I'm gonna have to look.
Those other ones. I use them, should I know?
Mm-hmm. They're in my Amazon cart somewhere.
They help. That's not.
Yeah. Broke the seal. How's this one broken?
So you are that cute.
Spider running the other day.
I'm sorry.
Where's he at?
He's always doing something. He is building an enclosure for my girl's
Me and him.
dogs.
Honestly, it's me and him.
It
broke
broke
last
last
year.
year.
For the
We
order
still
one.
want to order one. You need to order one because it's gonna be cold. Like now, this week.
You did this that time, right? Or you just answered her phone?
She just answered phone.
Yeah. Okay, easier.
Yeah, she's just gonna get past that.
Once she sees
If you
it.
read this. Read it, like seriously read it over and over. If you go line by line, and you look at the actual words. Word like me. And I look at the words. You'll find stuff. And it'll help you. If you got to look at this and read it. We always highlighted it.
Like when we first started. Say like.
The cheat codes. Mhm.
That's what you didn't know. I'll write it down.
Yeah, but that's when the tax year wasn't as lengthy too, that used to be the 2 pages.
Just because
I still have my notes.
how it is important not to mess up. You're gonna have that person.
Those are my notes.
But you never let the customer see you.
Yeah.
Yeah, you don't let them see you sweat.
If I go there and I'm sitting there and I see you look at something, then that's gonna be my trick.
It's repetitive, you gotta keep doing it, keep it, if you practice problems.
Yeah. All right, so let's go over. So we did 1 and 2, correct? Together?
Yeah.
Okay, so number 3, Sarah Scott. Sarah's divorced and she provides a home for herself and her dependent son. Her AGI is 35,670. What is Sarah's filing status? Head of household, which would make her taxable income $14,870. Because we're subtracting her AGI, we're subtracting out her standard deduction, and would make her tax $1,488. So, yeah, so she's in the 10% tax bracket.
Okay.
What is it?
1,488. 1,488. So, number 4, Ron Johnson's wife Barbara died last year. Everybody's just passing away. Ron has 2 children, and he had an AGI of $58,697. He also had a Schedule A amount of $17,700. What is his filing status? Married filing joint. What's his taxable income?
$30,997.
$30,997. Okay, so the Schedule A amount, because it wasn't more than the standard deduction, we're not going to use it, right?
Right.
Because we always want to give them the higher amount. Because if we would have went with that low Schedule A itemized deduction amount, we would have made them pay more in tax. So his tax then was $3,277 based on that $30,997 taxable income. Juan Salazar, age 20, he's a college student. His parents still claim him as a dependent. His adjusted gross income is $5,674. What is Juan's filing status? Trick question. What was his adjusted gross income?
He's not.
$5,674. Why is his right? And he does not get a filing status deduction because his parents have already claimed him. So then his tax is $568. 10%. Rosa Vega is married, but she has not seen her husband since 2019. That sucker just ran off. Her AGI is $27,800. She has 4 children. What is her filing status? Head of household. So even though she may still be married, she hasn't lived with her husband for 5 years. So her filing status is head of household. What is her taxable income? $7,000. Since her AGI is $27,800, you're going to subtract the standard deduction of $20,800, leaves her $7,000 taxable income, which leaves her a tax of $703. 10% tax bracket. Number 7, Gabe and Shelley. Gabe and Shelley got married on December 13th of 2023. Both are students. They're both under the age of 24, and they're both being claimed by their prospective parents, by each of their own parents. Their combined AGI is $8,000. What is Gabe and Shelley's filing status? Married filing joint. Why are you looking at me confused? No? Okay. Okay. And so then what is their taxable income? $8,000 because their parents are claiming them as a dependent. So they have no standard deduction, which leaves their tax to be 803. Sounding good? All right. Kelly and Mark, live with Kelly and Mark. They have never been married, but they call each other husband and wife. And they live in Texas. We'll just throw that in there. They live in Texas and they're calling each other husband and wife. Yeah, they're just not smart. They have one child and a combined AGI of $48,900. They have a Schedule A amount of $9,350. What is their filing status?
Married filing joint.
Married filing joint. Because they opened their mouths.
Mhm.
Their taxable income then is I got 21,200.
Yeah, 21.
Their taxable income, 21.
Oh, 21, yeah, 21,
Okay.
200.
And then their tax is, I got 2123. I don't know. Oh shoot, let's look. So their taxable income is 21,200. They're married filing joint.
2023.
Yeah, 2,123. Okay, at least, but less than. Just the wrong column. Just the wrong. All right. So Alexander Hamilton and his wife Eliza. She got tired of his cheating ass, and she divorced him on January 2nd, 2024. Okay? Yeah, they got married. They got divorced this year, January 2nd, 2024. They're old as hell. They do not want to file together. Alex has an income of $33,000. Eliza has an AGI of $48,371. We're just going to assume that that income is Alex's AGI. Okay. And Eliza also has Schedule A amount of $10,230. All right. So what are their filing statuses? Married filing separate. Okay. So what is Alex's taxable income? $19,150. What is Eliza's taxable income? I got 521. Yeah. All right. So, which means that Alex's tax is going to be $2,075 based on married filing separate. All right. Eliza's tax is going to be $3,923 based on married filing separate. Now, let's throw a little tailspin in there and say that Alexander Hamilton had some itemized deductions of $18,000, all right, which is more than the standard deduction. So then, because he itemized, Eliza is required to itemize, but her itemized deductions are only $10,230. So then she would actually owe more tax. He would owe less tax. She would owe more tax. If he wanted to be shitty, he could do that.
Wow.
Okay. So I know that is a lot, but it's just so you're not going to have to manually do any of these calculations, but it's just so that you know how that taxable income affects the amount of tax, so that you know where it goes and why. Where it goes and why. So, anybody need a break? Anybody need a drink? Anybody need to pee? Ducky's just back and she's like, I'm gonna hold it. We're gonna push through. So, we'll at least go to the restroom. before we tackle the last portion. The last portion shouldn't take us much longer. Man, I'm hungry. Jesus. Mm-hmm. I'll be right back. So I figured basically, make some flyers and have them print them over here at M&M.
Uh-huh.
And you guys can just get flyers and cards in different places. M&M has, they also have a place in Bay City too. That's their place, they have one in Bay City.
Oh, yeah. I think that's one we have to print it.
Yeah, they're really nice. I'd rather go to them than go to their office, 100%. They're so nice. Yeah, they're so helpful. So you can do cards there, just really different. Restaurants, yeah. Get back. Oh, so.
She's ready.
She wants to finish. So yeah, I would do that, but I'm gonna, I'll work on that and get those made. And then we'll go through over there to see what supplies. I don't think there's any supplies that are needed over there. Shouldn't really go through anything.
Okay.
All right, so we've done exercise 5 and 6. We are almost done. We're on the tail end of the tax return. All right, so we're gonna go back to the 1040. And those, they're just addition lines. Line 21, we're adding line 19 and 20. Line 22, we're subtracting line 21 from line 18. So basically all these are just determining the tax, what we just finished doing in that exercise, just determining that tax. All right. So we're going to skip on down to payments. Line 25, payments. So what, 5, 1040, page 1040? On the 1040, line 25, your payments. What are payments? Payments are things like the federal income tax withheld from your W-2s, from your 1099s. Any other forms where they might withhold tax, 1099 INTs, the bank might withhold some tax from there. So 1099 Rs from retirement, you might have some tax withheld from there. So those are considered payments made to the IRS. Okay, even though they're made on your behalf, you didn't make them, they're still considered payments made to the IRS. Line 26, 2024 estimated tax payments that the taxpayer had applied from their, either from their 2023 tax return or that they voluntarily made estimated tax payments and paid into the IRS. So a lot of small business owners or high income earners will pay estimated payments throughout the year. Every 3 months, they'll send in a check to the IRS to cover any taxes that might be owed, so that they're not penalized at the end of the year. Okay, those are made quarterly every 3 months. So the big one, the big payment, line 27A, line 27A, earned income credit. So we will, the majority of our tax returns are going to have earned income credit. Earned income credit is a big look-see for the IRS right now. They're really looking at the tax returns with earned income credit. So we have to make sure that we are doing our due diligence, which we'll go over in a later class, but we have to make sure that we're asking the right questions, make sure that the people are claiming their own children, all of that. But first, what is the earned income credit? The earned income credit, it's a credit for certain people who work. This credit may give you a refund even if you do not owe any tax. Qualifying child for earned income credit purposes is a child who is your son your daughter, your stepchild, your foster child, your brother, your sister, your stepbrother, your stepsister, or a descendant of any of them. For example, your grandchild, niece, or nephew who was under the age of 19 at the end of 2024, or under the age of 24 at the end of 2024, and a full-time student. Or they can be any age, but permanently and totally disabled, and they had to have lived with you for more than half of the year. So, son, your daughter, niece, nephew, grandchild, lineal descendant of, they had to live with you for more than half of 2024, be under the age of 19. If they were not under the age of 19, they had to be in school. If they were under the age of 24, they had to be in college. Or if they're older than that, they had to be permanently and totally disabled in order to claim the earned income credit. Okay. So if you have a qualifying child, your qualifying child has to be younger than you in order to claim them and receive earned income credit. Sometimes we'll have brothers or sisters or brother who is actually maintaining the home, taking care of his brothers and sisters. He has to be older than the children on the tax return in order to claim them for earned income credit purposes. So it can't be the younger brother maintaining a home for the older siblings and get earned income credit for them, unless that child is disabled. And if he's taking care of an older sibling who is disabled, might be autistic or have physical disability, then yes, he can claim earned income credit for that child. They may not have filed a joint return except to claim a refund. So that same situation with the parents that claim the older children who may be married, but they're only married, they're only receiving their withholdings, right? Y'all remember that situation? Mom and dad's claiming the college because my brother who went and got married. Well, mom and dad can claim him as a dependent, but then now they can also get earned income credit for him. Okay? Because he's only filing just to receive a refund. Now, a taxpayer can also have investment income, but that investment income has a cap. If they have more than $11,600 for the year, then they cannot receive earned income credit. What's investment income? Interest on your bank accounts is investment income. Stocks, investment income. So they can't have received more than $11,600 in investment income and receive earned income credit. It would be disallowed. Okay, it wouldn't even calculate. So if you look below, in all caps, it says, all qualifying children must have a valid Social Security card. It cannot read not valid for employment. So they have to have a full-fledged Social Security card in order to receive earned income credit. All right. They can't have an I-10. So no individual taxpayer identification numbers. None of those numbers that start with a 9. So they can't receive earned income credit. And back in 2021, the IRS did allow 19-year-olds, non-dependents, to receive earned income credit. Non-dependents, non-students. So if your 19-year-old is on his own completely, you're not providing for them at all, they live on their own, and they make less than $18,000, they can receive earned income credit on their own behalf. Without any dependents, without anybody. They can receive it on their behalf. It's not a lot, but they can still receive some. So down below is the 2024 earned income credit chart. It shows you the number of qualifying children that you can have, the filing status, and the maximum income that they can make within those amounts, and then the maximum amount that they can receive. So these numbers just kind of phase out, in and out, depending on the number of kids and the amount of income that's received. But this is just a base. So if you don't have any kids, you file single head of household, qualifying surviving spouse, you have to make less than $18,000 to receive at the maximum of $600. And then the same for one dependent. $47,000 max AGI. The maximum amount that you can receive is $4,000 for one kid. For two kids, max AGI is $53,500. The max EIC is going to be $6,600. For three kids, that's it. You only get EIC for three kids. So for three kids,
So you have 6 kids,
you're only going to get earned income credit for three. Now, you get child tax credit for all of them, but you only get earned income credit for three. So that was a big fraud indicator for the IRS. Not an indicator, but a loophole for them. They created a big fraud scheme within their own system because they're only allowing taxpayers to claim 3 kids for earned income credit. That leaves 3 kids open. That's why these people were selling their kids or giving their kids to.
so then someone else would get them, and then
They would claim the earned income credit for those kids, or they would claim those kids and get earned income credit for them because they're not useful to said taxpayer. So let me sell them. It was a big, it was a big, still is a little bit, but not so much. It used to be really, really bad, but not,
But at
we're
that
not
time-
seeing it a
At
lot.
that time, you weren't providing.
You didn't have to.
Okay.
You didn't have to. Now more of the burden is placed on us. We have to, like, say if you came in and told me I'm claiming my nieces and nephews, I'm claiming 3 nieces and nephews. I have to ask you, how were they placed with you? Where are their parents? Why aren't their parents claiming them?
Do you have school records?
Right.
Anything that has your name, address?
Mhm. So we have to ask you that.
Okay.
Now, I don't necessarily have to see it, but I have to make sure that I notate that I asked you about it. And if you've got it with you, I have to make a copy of it. Okay. Because we can get fined $600 for each instance on a tax return. So a tax return can essentially cost you up to over $2,000 because you didn't ask the right questions. Okay. So line 28, additional child tax credit from Form 8812. Additional child tax credit is an amount that is calculated when you have 3 or more qualifying children for the child tax credit and you don't have any tax to offset. So they're calling constantly.
Yes. Okay.
What did he want? Why did he call David's phone number? Okay. So in some cases, you are entitled to receive a portion of that credit as a refundable credit. So if you have 3 or more kids, they're going to give you an additional amount of child tax credit that's refundable. And the computer does all those lovely calculations for you. So line 29 is going to be the refundable portion of the American Opportunity Credit or that education credit. Remember how I told you up to $1,500 of it could be a refundable credit? That's where that goes. And it takes it, computer takes it where it needs to go if part of it is refundable. Okay. Line 31, the amount from line schedule 3, line 15. Other payments and refundable credits. So let's go take a look at that. Schedule 3, line 15. So those credits can be anything from your net premium tax credit, excess Social Security. So if a spouse, a husband and wife paid in too much Social Security in their paychecks, they can receive the excess here. Credit for fuels, federal tax credit on fuels. That was a big scam thing last year, big fraud thing that they were doing last year. These tabletop preparers. So those could be other things that you could receive credits on that would pull forward onto your 1040. So we just talked about net premium tax credit. That's say you underreported when you applied for marketplace insurance and you underreported. and you paid more in your tax premiums and in what your premiums, insurance premiums and what you should have, then you could receive some credit here for that. Schedule 3, line 10 is the amount paid in request for an extension to file. So you filed an extension. You couldn't get all your stuff together on April 15th, so you filed an extension. With that extension, you thought you might probably owe when you filed on before October 15th. So you went ahead and you paid what you thought you were gonna owe. So that's where that goes. Because when technically, if you owe on April 15th, you still file an extension. If you still owe come October 15th, you're gonna pay a penalty for not paying on April 15th. So they will penalize you if you don't pay. Regardless, that extension is only good for the tax return, not for the amount owed. So Schedule 3, line 11, excess Social Security. We talked about that. If you pay too much into your Social Security, you can receive some of that back. Schedule 3, line 12, credit for federal tax on fuels. We won't see it. Then line 13, Schedule 3 is other payments and refundable credits. So we're going to pop right back over to that 1040. We're going to take anything that we had there. We're going to put it back. We're going to take it back over to that 1040. So line 32 on the 1040 is where you're going to total those other payments and refundable credits. Line 33, we're going to add those lines. We're adding 25D. We're adding 26. We're adding 32. These are our total payments. Then we get over to our favorite section, the refund section. So the refund section, line 34 is if line 33 is more than line 24, you subtract 24 from 33, and this is the amount that you overpaid, right? That's the amount that you paid too much money into the IRS. That's what goes there. Line 35A is the amount that you want refunded to you. So they don't just automatically give it to you. You have to request it. So you have to tell them, I paid in $500 too much. I want $500 back. Okay. So that's what 35A is. And then, ooh, we're almost out of battery. And then line 35B is if you want it direct deposited. So if you want those direct deposited, then you put in your routing and your account number, and the IRS will direct deposit that into your account. All right, and then amount, line 36 is the amount of line 34 that you want to apply to your 2025 estimated tax. So if you want any of that refund to be applied to the next year's tax, you can also do that. Right? Now, then again, amount you owe. So if in reverse, if you subtract line 33 from line 24 and it's in reverse, you owe. So you would have to pay the IRS what you owe them. All right. Line 38, estimated tax penalty. If you owe too much, you didn't pay enough withholdings and you owe too much, they can penalize you for not paying enough in. Yeah, it's like $150. Some if you didn't pay, I know the limit's $150 and then they can penalize you. So third party designee, this is where you designate the person that you want to talk to the IRS on behalf of the taxpayer. That information would go there. And then the signing. That's where the tax preparer would sign that portion of the tax return. I mean, the taxpayer, spouse, if there's a spouse, they would sign and date it. And then you finally, as the paid preparer, would sign the tax return. All right. So that completes the class. We are going to do our final set of class problems, determining whether or not the taxpayer is entitled to earned income credit. All right. I'm going to plug it in while everybody else is doing that. Okay. I'm plugging you in. Somebody here? Because we will die. We will die. We will die. All right. So everybody work on those. work on those for a few minutes and then we will go over them together. Yeah. And you're gonna use the chart, that or the income credit chart. This one right here, to determine whether or not they're eligible. Mm-hmm. Whatever it's called. Says 61.
I got the AC on.
Here?
No, that's the heater?
Yeah, well, I just have it on 70.
Yeah. Right. It usually says nope. That's what I was saying. What if she had? So if they decide to split.
Everybody good? Y'all ready? All right. Okay, let me move you back. I got you a little bit of juice now. Okay. So final, oh,
I'm so sorry.
no, you're good. So, okay, final class problem set. Determine whether the taxpayer is eligible for earned income credit. You're gonna use the table in your training packet, okay? So, Bill has had a household. He has 2 dependent sons, ages 10 and 15. He provided a home for his sons all year. His adjusted gross income is $38,140. Is he eligible for earned income credit?
Yes.
Yes, absolutely. Because his income is beneath the threshold for head of household for 2 kids, which is $53,500. Right? All right, Derek and Meredith, number 2. They left Grey's Anatomy, okay? Uh-huh. Yeah, that's all they were making over at Gray Sloan Memorial. Then, they had to go. Derek and Meredith are married. They're filing joint. They have 3 kids, ages 10, 15, and 19. Damn, Zola's 19 already? The 19-year-old is a full-time student and lives at home. The combined adjusted gross income is $52,505. Are these taxpayers eligible for earned income credit? Yes, they are. Mara is single and has 1 daughter. The divorce decree states that her ex-husband can claim her daughter as a dependent. Her daughter lives with Mara, and she provides a home for her. Her adjusted gross income is $35,157. Is she eligible for EIC?
I said no. Only because he's got,
Yes.
yes,
Yes.
even though the dad is,
The dad can claim her as a dependent. The mom can still file head of household and claim her for earned income credit purposes.
yes.
You would have to, well, okay, so in this situation, what are the questions that we would ask her? We would ask her to provide proof that the child lived with her, maybe a copy of the divorce decree,
Or
school records, and address, something with the address.
Yeah.
So
Should have that,
it'd be no. I mean, I'm sorry, you can't prove it. So, in order to cover my
So it could
liability,
go either way.
right?
Either-
In order to cover my liability, what'd she say? We ain't gonna do it. Yeah. So Jensen, where does this one come from? Jensen, Supernatural.
Yeah.
Is single with no dependents. Jensen Apples is single, 19, single, no dependents. No one claims him as a dependent. His adjusted gross income is $14,605. As a single taxpayer, is he eligible for earned income credit? Yes, he is, because his income is below the threshold of $18,000. So Javier and Grace, they have 4 dependent children. Grace has an ITN. They file married filing joint. Their combined adjusted gross income is $55,367. Are they eligible for EIC?
No,
No.
because that ITN is automatically.
Yep.
shuts that down.
Automatically. Anytime one of the taxpayers, primary or secondary taxpayer has an I-10, they're ineligible for earned income credit. Yeah.
Should we take their money though, don't they?
They sure do. They sure are keeping it.
Yep.
So that completes the class for today. All right.
Ooh, we did good.
Are there any questions?
What time is it?
2:44.
Ooh.
And we started late. Not bad. Not bad at all. Samantha, any questions? Guys, any questions?
No, ma'am, I don't have any questions.
Okay. All right.
I'm gonna go back and review. it.
Yeah, I'll upload this. I'll have it uploaded by tonight to my YouTube channel. My YouTube channel is AccuTax Service.
Okay.
It's just the company name, AccuTax Service. So I'll upload it there. Oh, so-
That's Kylie.
and then you'll be able to, you'll just be able to review it.
Okay.
Okay?
I'll see if my son can put it on my TV.
Yeah.
Where I can focus. more.
Yeah. Oh, I love watching YouTube on my TV.
Yeah.
I do it all the time. So I'll look up different classes and I'll look up on YouTube.
Okay, yeah.
All right. So that concludes it for today. Samantha, thank you.
Thank you.
And like I said, I'll have this on YouTube probably by tonight. Okay?
Okay.
All right. Have a good one. Bye.
Bye, Denise.
Bye.
Because I understand and I'm hearing you, but
Subscribe to your YouTube.
Stop recording. Okay.